is a Fed that could be on hold for a long time.
The economy is running okay right now. They don't want to get ahead of this.
Powell's going to be very hawkish.
The Fed's in a tough place. I'm expecting to hear not a whole lot.
The Fed's hands are tied to deliver the kinds of cuts that we've seen in prior cutting cycles.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, preparing to de-escalate.
The world has been coming to the U.S. and China has been the missing piece. What we're going to do in Switzerland is we've agreed to talk. Then on Saturday and Sunday, we will agree what we're going to talk about. My sense is that this will be about de-escalation, not about the big trade deal. But we've got to de-escalate before we can move forward.
Talks are scheduled between the US and China as both sides look to dial down the temperature. China's central bank choosing to cut interest rates heading into trade negotiations this weekend, just as the Fed is set to leave rates unchanged this afternoon. The committee facing a wide range of outcomes for the year ahead and beyond.
And since the last Fed meeting, what we've seen, if you look at just the overall change in yields, overall change in markets, isn't that great. But everything has changed when you actually see how some of the tariff policies have been implemented. The question for the Fed at this meeting is not necessarily what they're going to do. They're going to try to get off the stage as quickly as possible and fade back into the background. It's how they telegraph going forward what the biggest risk is at a time where suddenly the market is starting to really embrace the idea of stagflationary-like conditions.
A lot has changed since March 19th, the generational shift potentially in trade policy in the Fed. The Fed's now facing down the outcome of talks, which could be 100% tariffs on China, 50% tariffs on China, 10% tariffs on China. Nobody knows.
We don't know the rate, and this is the strategic uncertainty that the Treasury Secretary has spoken about. What we do know is that this is a significant step towards de-escalation. It's not towards a deal. But the fact of the matter is they are going to have this high-stakes meeting to have talks. So the direction of travel is likely going to be tariffs coming down, and that tension between Beijing and Washington just getting a little bit more loose.
We've got a lot to get through this morning. Looking to snap a two-day slide on the S&P 500. Equity futures positive by 0.5%. Coming up this hour, we'll catch up with Julian Emanuel of Evercore as the US and China plan to negotiate. We'll speak to the former senior Trump trade advisor Kellyanne Shaw and why Francis Donald of RBC is calling uncertainty the new normal. We begin this hour with stocks pushing higher on optimism for US-China trade talks. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, good morning. Walk us through the focus of these talks this weekend.
Yeah. Hey, John. Good morning. Well, this is considered to be the formal jumpstart of negotiations with China after Treasury Secretary Scott Bessent told lawmakers yesterday that they had not started talks as of yet. In an interview, he declined to say who called who first, saying instead that this is the result of many talks over time. Now, you mentioned there Saturday and Sunday. The goal, our understanding is it really has to be all about de-escalation first before they can get into any sort of talks about a potential trade deal. China has, of course, called on the U.S. to remove tariffs on a unilateral basis. And while the White House still insists that Beijing has to take the first step to de-escalate, ultimately, President Trump has signaled a willingness to lower tariffs on Chinese imports, saying that the current situation amounts to a trade embargo. And Scott Bessent said in an interview that everything is on the table. Now, not necessarily new sentiment from this White House, but does illustrate that softer tone that we've heard from officials in recent weeks that have led us to today. Of course, still, though, the list of grievances against China is long, anything from fentanyl to TikTok. But Scott Bessent did make clear in an interview yesterday that the ultimate goal here is not to decouple from China completely, but rather just from those strategic industries. John, we'll have to see how this ends up shaking out. President Trump in recent days has said that if negotiations don't go well, he's willing to just set a rate. And Bessent said his message to Wall Street on that is to understand it's all about strategic uncertainty, as China's Commerce Ministry in a statement this morning said that they hope the U.S. can be more sincere going forward.
The Treasury Secretary yesterday in that interview, Tyler on Fox News, talking about how him and Trump, they have all the information, but they're not going to disclose it. They don't want to show their hand. But he did say, as you mentioned, they want to decouple when it comes to things like textiles. They don't, but they want to decouple when it comes to national security issues. That's de-risking. So what kind of sectors are we looking at?
Right, exactly. It's really those sectors that we've already sort of seen the administration point out, particularly when it comes to their Section 232 tariffs. That's steel and aluminum, also pharmaceuticals, as we await potentially in the next 2 weeks, President Trump saying that we could see those sector-specific tariffs put into place there. We have to keep in mind that when these talks do officially get underway, it's going to be a lot about forward-looking, about, as you're talking about, de-risking, fentanyl concerns, TikTok concerns, but also these talks are going to touch on previous concerns. Treasury Secretary Scott Bessent has said time and time again that he also wants to revisit some of the lack of compliance under the Phase 1 trade deal. You'll recall during his confirmation hearing, he even floated that he would be interested in putting in some sort of buyback catch-up provisions to hold China accountable, particularly when it comes to agricultural purchases.
Tyler Kendall. Tyler, thank you. Down in Washington, D.C. Elisa, this market is just happy there's talks. They don't care who initiated them. They just want talks. At some point, we've got to think about substance. Annmarie's talked about this repeatedly. It took 18 months last time around to come to an agreement. How long is it going to take this time around?
And not just to get to an agreement, to get to the contours of what the ultimate goal actually looks like and what kind of economy are we actually heading toward. Francis Donald of RBC, who's coming up later this hour, talked about how it's not recession or not recession. It's the idea of how much growth slows and how much prices increase and what the capacity is for the consumer to absorb that.
Here's the take from Evercore. Julian Emanuel is somewhat cautious. Here's the quote from him. Given the uncertainty on policy and the economy, and with stocks expensive, 3+ steps forward rally is set to yield to 2 steps back correction. Julian joins us now for more. Julian, good morning.
Good morning.
I want to give you some credit. A number of weeks ago, still a lot of panic out there, a lack of confidence, and you said we've seen the lows, recession averted. That certainly looks like a good call. This morning, at least. Can things change and how quickly?
Well, it's amazing, John, because when you think about it, right, as long-term investors, we are supposed to be thinking 12, 24, 36 months in advance. And in this environment, there is so much news and so much change that you can barely think 12, 24, or 36 hours in advance. And that was really part of the condition that set up that low on April 7th. You know, just abject panic about the state of the economy, the need to de-risk. And from our point of view, we do believe that you are going to, and it's obviously a difficult path, avert the recession, barely. But again, when we think about where the market is right now, there's that high level of uncertainty that makes it, a difficult proposition to commit capital long term.
Elisa framed the economic outcomes quite well. This is not just about recession or no recession, and we'll continue that conversation later on this morning. We've seen growth expectations come down from 2 to somewhere closer to 0. And I just wonder what your expectations are now for nominal growth in the year ahead and what you need to see from these talks between the US and China. What's achievable? What's reasonable?
Well, I think the acknowledgement, and I think Secretary Bessent is painting it the correct way, is that this is a process. It's going to take time. It's going to take a number of months. There will probably be wins announced, small ones, over the next several weeks. Obviously, TikTok is an issue that's coming up again in reasonably short order. But from our point of view, again, just the fact that the process is going in the right direction is a plus. But at the end of the day, and as you said at the top of the show, we don't know where the landing zone is. And if the landing zone is a global weighted tariff rate somewhere of around 15 to 17%, that's still extraordinarily high by historical standards. And that brings you to growth in our mind. We're looking for 0.9 for the year.
Is this a stagflation type environment that calls for a stagflation type playbook that we haven't seen for many years?
Well, we would actually say that, and again, in true market discounting fashion, is that that's already been discounted. So in the stagflation playbook, the market averages annually a 10% decline, led by sectors like energy and consumer staples. And we've seen in various points of the last few months, those themes play out. To us, it's actually, again, I go back to what I said a little while ago, to the extent possible and necessary, we want to look through this under the assumption that all sides are incentivized to make sure the global economy stays on course. So we think that now's the time to re-engage in the longer-term themes of the sectors that were leading prior to the sell-off and the sectors that we think are going to continue to lead, technology-centric.
Okay, you say you look through this, but what is this that we're looking through? And I think about what you just said, which is the market's pricing in a stagflationary-like scenario, but they're not necessarily pricing in a Federal Reserve that responds to stagflation. They are actually pricing in a Federal Reserve that responds to something more like recession or more like some kind of sort of negative growth shock that maybe isn't in the cards if we have a stagflation type of environment. How much is that the ultimate wild card? Whether the Fed is going to respond to this like some sort of recessionary-like condition versus stagflation, which is much more difficult.
So look, there's no question about the fact that we will find out, we already know this, but we'll find out more, that the Fed's hands are in fact tied to a certain extent, and that obviously goes back to the ratcheting higher of inflation expectations. But ultimately, I go back to Chair Powell's use of the T word, transitory, a number of weeks ago. I don't think he would have used that without having true conviction, whether it's a function of demand moderating inflation.
It has happened before, but go on.
Well, you try not to repeat the same mistakes, but actually to us, that's the path forward. And I would say that, in fact, as we've seen in other times over the last couple of years, if we take the under on the number of cuts the market is pricing, that will end up being a market positive.
How challenging is it going to be as these talks start? And to Jonathan's point, first time around 18 months, we see fits and starts sometimes when it comes to these negotiations. How challenging is it going to be to keep your head on and look straight ahead and say, I'm not going to get distracted by all the stop and start and go and potentially some of the rhetoric that will come from this?
Well, that's kind of why we're cautious in the near term, within the context of our view that April 7th low was the resumption of the structural bull market, that at some point down the road we are going to see new all-time highs. But to your point, it's even more of a challenge because we know we're about to get data that's going to scare us over the next number of weeks and months.
What does scary data look like?
To us, it all goes back to the labor market. So the thing that we focus on the most is the high-frequency weekly jobless claims. If that starts nudging towards 300,000, that's when you're going to get sort of growth scare act 2, and that's sort of our two steps back process.
Takes us back to the Fed. Last summer, we know what they did. They reduced interest rates by 100 basis points. The moment you got a freak out in the labour market, just a small one, in the summer of last year, that's when it started, they moved. Are they constrained this time?
They are constrained. There's no question about it. And, even more so because they're certainly going to get political pressure in however many hours that's going to be. But the fact is that the inflation dynamic is different and at risk of being more anchored than it has been in the past. We don't think ultimately it will be, but there is that risk.
The president doesn't like it when other central banks reduce interest rates, and it's interesting that going into this one, it's not the ECB this time around, it's the Chinese.
And they're doing it pretty aggressively to pave the way for fiscal stimulus. In addition, it's basically everything the U.S. isn't doing, and they're setting the stage potentially to bolster an economy that has been flagging, but also potentially to sort of set the stage for retaliation potentially to head into these talks.
Julian, it's good to see you, sir. As always, thanks for dropping by. Julian Emanuel there of Evercore. Look out for our coverage of the Federal Reserve. The Fed decides a little bit later on this afternoon. That kicks off at about 1:30 Eastern Time on Bloomberg TV. Equity futures right now positive by 0.6% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnad. Hey, Yahara.
Hi, John. Pakistan says it has shot down 5 Indian planes carrying out strikes inside its territory. India says it ordered the strikes against what it calls terrorist camps after last month's attack in Kashmir that killed 26 people. Pakistan says 8 civilians were killed in the Indian raids and has vowed to respond. Meanwhile, Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer will hold talks with China's Vice Premier He Lifeng this weekend. The officials are due to meet in Switzerland on Saturday and Sunday. These will be the first confirmed talks between the two countries since President Trump announced tariffs of up to 145% on Chinese imports. And a check on AMD shares. Those are rising 2.8% in the pre-market, despite the company warning it will lose $1.5 billion in revenue this year due to U.S. export curbs to China. Overall, the chip maker was upbeat about AI infrastructure demand and predicted strong sales growth in the second half of the year as it debuts new chips. That's your Bloomberg brief. John?
Yahara, thank you. Yahara will be back in a 30 minutes or so, about a half an hour, to catch us up on the latest with Champions League football. What a game yesterday afternoon. Just absolutely phenomenal. I'm exhausted. Equity futures positive this morning. Up next on the program, preparing to de-escalate.
The world has been coming to the U.S. and China has been the missing piece. This isn't sustainable. As I said before, especially on the Chinese side, we don't want to decouple. What we want is fair trade.
Talks about talks this weekend. The former senior Trump trade advisor Kellyanne Shaw joins us next, live from New York City this morning. Good morning. Back-to-back losses on the S&P 500 for the first time this month. Looking to erase some of that this morning. Positive by 0.6% on the S&P. On the Nasdaq 100, higher by 0.6%. Also, under surveillance this morning, preparing to de-escalate.
The world has been coming to the U.S. and China has been the missing piece. We have shared interest that this isn't sustainable, as I said before, especially on the Chinese side. And, 145%, 125% is the equivalent of an embargo. We don't want to decouple. What we want is fair trade.
So here's the latest this morning. US and China trade talks officially opening up, with the Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer set to meet with Chinese counterparts over in Switzerland this weekend. Joining us now, the former senior Trump trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the program. Can you just help frame these discussions, what it looks like going into the weekend?
Yeah, good morning. And this is certainly the announcement that we've been waiting for. Clear and overt signals from both the United States and China that they intend to engage in discussions to de-escalate from the current trade embargo. And so what Secretary Bessent outlined last night in his interview was that they would have 3 days of meetings. The first day would be about scoping out what the discussions would encompass. And then he predicted the next 2 days would be just about this de-escalation issue as opposed to broader trade issues. Now, that said, if you have 3 days worth of meetings with the two biggest economies on earth, they're certainly also going to be talking about things like phase one compliance, potentially talking about what a broader trade negotiation could look like. But I don't expect them to get much into the substance of that, rather just focusing instead on de-escalating from these current 125% and 145% tariffs.
Kellyanne, for China to sit down, they said that they wanted to see the 145% rate drop. Could we see that by the end of this weekend?
I would expect that there might be some sort of announcement coming out of those meetings with respect to the tariff rates. Now, going from 145% all the way down to zero, I have no expectations for. But whether we de-escalate down to something like 30, 40, 50%, I think something like that might be more realistic. And then on top of these reciprocal tariffs, we also have the 20% fentanyl tariffs, which really for President Trump to de-escalate from, China would need to come prepared with some sort of concession, at least on the drug front.
The Wall Street Journal a few weeks ago said that China was looking into that. Do you think that is an olive branch they can offer up this weekend?
Potentially. And we've seen a number of olive branches and signals play out over the past week where China has not been collecting tariffs on certain shipments from the United States, signals from Chinese officials, from Chinese surrogates. Now, to the extent that China is willing to negotiate on the drug front, I certainly think that there could be flexibility there. Again, I'm not expecting these tariffs to go back down to zero or even 10 or 20%, but somewhere where trade can still happen and there is an opening, at least for further discussions.
Kellyanne, we heard from Scott Bessent, Treasury Secretary. We don't want to decouple. What we want is fair trade. Do we have a sense of what the ultimate goal of what fair trade looks like between the United States and China?
Yeah, and what was interesting about that comment, too, is that when pressed on some of these more national security supply chains, he did say we want to decouple from those. So the supplies and the production lines that we would need in the event of a pandemic, some sort of military conflict, national security event, that we would be able to produce those in the United States. But for everything else, and he pointed out textiles and T-shirts as well, that we would allow trade to continue. But I think the list on the side of the United States has been longstanding and public. And so that has to do with the things that are in that Section 301 report from back in Trump 1.0, has to do with unfair subsidization, some of these industrial policies, anything related to technology transfer, IP theft, or the manipulation of markets. Now, that's a big list, and that's a big ask on the U.S. side. And so the question for me is, what's China going to ask, and is there really scope for any sort of deal there? But in the meantime, it's about de-escalation.
As the market tries to figure out a timeline of how long this is going to take and how volatile it potentially could be, Kellyanne, what was the signal that you took from the package of stimulus that the Chinese authorities put out before some of these talks kicked off to maybe uphold its economy, but also maybe to gird for potentially a rocky path that includes retaliation?
Yeah, and I think what you're seeing is that the Chinese government has been saying for the past several weeks that this is the U.S.'s problem. We're going to wait the United States out. We don't need the United States. But in reality, behind the scenes, there's quite a bit of anxiety and nervousness there. And that's why we've seen them now announce this package of financial measures to help with their own economy. But I also think that it signals what Secretary Bessent has been saying out loud for some time now, which is don't look for a huge U.S.-China trade deal in the short term. These are the two biggest economies on earth with long-standing entrenched issues. This is going to take years to work out, not just days or weeks.
Kellyanne, we know the Chinese like to drag things out. It took 18 months last time around. I'm just thinking about the individual demands, just to build on Lisa's questioning. When it comes to these talks, I know what the US wants. They want to address things like fentanyl. They want to address the trade imbalance. Maybe they revisit purchase agreements. It's the ask from the Chinese side, which I think are harder to follow through on, actually. When they ask for things like lifting tech restrictions on US technology, isn't that going to be a red line for negotiators over the next several months?
Yeah, and that's why I think this is going to take a much longer period of time to work out if it is able to be worked out. Asking for the lifting of export controls, investment restrictions, some of these human rights related legislation, all of this is going to be incredibly difficult for any U.S. president to do, in part because the mood of the country has moved so significantly into this bipartisan consensus about the challenges posed from China that there isn't a lot of runway there. And so I think that these are going to be hard, if not impossible, asks by China. So that is why I think we are in for what you said to be a rocky road for the next couple of years. But in the meantime, the administration is focused solely on this de-escalation. And I think China is also focused solely on this de-escalation so that at least some trade can continue between the world's two largest economies.
Can we just think about the other economies before we wrap this up? What Pantheon Macroeconomics calls this morning satellite manufacturing economies of China, the likes of Vietnam. Who are they closer with right now, the US or China?
So a lot of the Southeast Asian countries, including Vietnam, see China as their number one trading partner, which is true just in terms of pure trading volumes. But I think they're stuck between a rock and a hard place. And most of these countries are asking not to have to choose between the United States and China. They see both as important trading partners, both as important allies. And we're seeing this play out in these negotiations that are happening with the U.S. administration, where they are asking for concessions and asking for countries to ensure that Chinese products aren't coming in and aren't circumventing potential tariffs between the United States and China. And that is a hard ask for a number of these countries, but I don't think that the United States can agree to some of these deals unless these countries agree to their own measures to stop Chinese goods from coming in.
Kellyanne, I have a feeling we'll be talking with each other for a long, long time about US-China trade talks. Kellyanne Shaw, the former senior Trump trade advisor. Kellyanne, thank you. Annmarie, one of the first moves from the Chinese leader, what was it? To secure ties with some of those economies.
Absolutely. And when it comes to usurping around what the United States has put up in terms of the tariff rates, China's already doing that. It's called washing. They're throwing goods, dumping into other economies, and then telling those economies and those manufacturers, send them to the United States.
The fact they're talking is good news. The bad news is they might be talking for a long, long time without the policy changing. Equity futures right now positive by 0.6%. Up next, Bloomberg's Rishi Bhatia as India and Pakistan trade military strikes. Equity futures positive here by 0.5% on the S&P 500. On the Nasdaq, up by 0.5 also. Some outperformance on a Russell. The small caps up by 1 full percentage point so far this morning. Early days, 3 hours to go until the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. The earnings season rolls on. We had AMD after the bell yesterday. What a ride it's been for this company. It reports results, gave a very upbeat forecast, and shares rose 6%. But at one point, they turned around and they started to fall after the company said it would take a $1.5 billion hit because of U.S. restrictions when it comes to Chinese chips. This is basically the biggest competitor to NVIDIA. But that loss turns around to gains again. We're up 2.4% this morning. But what's decisively down in tech is Supermicro Computer, also reporting earnings post-market yesterday, giving a disappointing outlook, a disappointing set of results. And it's surprising it was this disappointing, considering that they pre-warned the market last week saying that things would look lackluster. Orders for them have been delayed. They make servers that you need to use for AI, saying that it also might be because of economic uncertainty and tariffs that is impacting them in the short term. So those shares down 5% this morning. Finally, we also heard from Novo Nordisk this morning. It actually cut its guidance. But look at what the ADR is doing. It's up nearly 5%. It's even up more in the Danish trade. And you also have other pharmacy stocks rising with it. Eli Lilly, which also has its obesity medication. And that's because Novo Nordisk said that the competition from compounding pharmacies, it assumes, is going to wane in a big way later this year. The shortages are gone. The FDA rule that allows those compounding pharmacies to make obesity medication is going to start to pull back. So you're also seeing Lilly up 1.7% on that report, John.
Danny, thank you. Great work as always. More from Danny in the next hour. On a radar this morning, one of the top stories worldwide right now, India conducting military strikes against, quote, known terror camps in Pakistan in response to a militant attack in Kashmir last month. A Pakistani official telling Bloomberg his country shot down 5 Indian fighter jets.
There's a lot of concern here that this can potentially become more of a hot situation between these two countries. Prime Minister Modi has said he would retaliate. He said perpetrators that would be punished for that attack in Indian-controlled Kashmir. The United States has been trying to de-escalate this for days. Marco Rubio, a number of readouts from the Secretary of State last week between Pakistan, between India, and at this moment, it wasn't able to work, but potentially they are looking for some sort of off-ramp right now.
I think a lot of people are, considering it's two nuclear powers that are right next to each other and have contested this area for a long time. Pakistan has emphatically denied that they were responsible for an attack on mostly tourists in this contested land. The discussion has been very careful, and the rhetoric has been careful. There has not been a desire to escalate. And what happens, though, when you start with these types of tit-for-tats, sometimes things can get out of your control.
We had a flashpoint for tensions a number of years ago, I think back in 2019, and things de-escalated pretty quickly, and we hope they can de-escalate pretty quickly all over again. We'll have you an update on that story in about 5 minutes' time. I want to turn to this one. U.S. Treasury Secretary Scott Bessent and Trade Representative Jameson Greer travelling to Switzerland this weekend for trade talks with China's Vice Premier. The talks aiming to de-escalate the tariff standoff.
And we just talked to Kellyanne Shaw, who said essentially de-escalation might mean the beginning of talks that could last years. Meanwhile, we have China's Commerce Ministry calling for the U.S. to show sincerity in these talks. You have Scott Bessent, Treasury Secretary, saying we don't want to decouple, but what we want is fair trade. It is very difficult to see some sort of contours of an agreement coming together quickly. Is this enough to really justify some of the reprieve that we really seem to be getting in market pricing, if not in actual policy?
A deal will take a lot more time, but Kellyanne was pretty, I think, accurate when she said, given the fact that a number of officials, especially Scott Bessent, said these rates are unsustainable. At the end of this meeting, what you potentially could see is the drop in rates. And that is going to then be, I think, in earnest, a starting point to have these trade negotiations.
That's implied by how both sides have approached these talks about talks. To your point, the Treasury Secretary has said they're unsustainable. From the Chinese side, they have said they're not willing to engage in real negotiations until those tariffs come down. So the question we've got to answer is, come down to what?
Exactly. And I think you have to go back to what the president has said on the campaign trail, 60%. I think somewhere between the 35, 40% to 60, 70, 75% maybe will be an acceptable rate. But in that, a lot of analysts say that is still an embargo, basically, in terms of trade between these two countries. Most interesting about Bessent last night was the fact that he said, we don't want to decouple. when it comes to the knickknacks, the textiles, but it's about decoupling when it comes to really important national security sectors.
The market's just happy we're de-escalating, that we're talking. It's difficult to escalate any more from 140-something% on Chinese goods. The market might need more than that in the future, though, and this is what the economists are focused on. I think that's the difference right now, Lisa. The difference between what market participants are focused on, talks about talks, and what economists are focused on, which is the prospect that the trade volume coming into the United States rolls over and you start to see the empty shelves.
And what does the sort of CEO have to say about this? Did you see the numbers out of Shein and Temu? They were down dramatically in the week from April 25th to May 1st. Shein's sales dropped 23% in the U.S. in that period versus the week before. For Temu, it was 17%. So you can see a real material response as prices go up, that consumers are really pulling back. So things happen in the meantime. It's not like this is a static type of negotiation.
Well, with closing of de minimis, which means that anything under $800, you don't have to pay this tariff rate. With the closing of that loophole, there is literally no point to going out and buying some of these cheap Chinese goods. So the big question is, where is China going to be dumping so many of these cheap goods? And we're seeing in a lot of these Southeast Asian countries.
More on the talks throughout this morning. It is helping the equity market. Equity futures positive by 0.5%. We need to wrap it up with the most famous succession planning on the planet. 133 Roman Catholic cardinals gathering in the Sistine Chapel to elect a new pope. They will not be allowed to leave until they reach an agreement. Once the conclave reaches a decision, a plume of white smoke will rise from the Vatican roof and the new pontiff will be announced.
Just want to point out that it's 133 cardinals from 70 countries. That compares to 115 cardinals from 48 countries the last time around. So this is going to be a really volatile type of session. They're not allowed to look at their phones. They're not allowed to have any external communication. In 1268, it took 3 years. I assume it'll take a little bit less time this time around.
Fumanta Bianchi, and then what they have is the ringing of the bells in St. Peter's Basilica, and everyone literally gets so excited about this. I was reading the story about actually, and Jonathan, you've talked about this, the numbers of the youth actually turning back to religion and Catholicism, and this potentially, I think, because some of this has also been made into seasons on movies and on television, there's a lot of excitement. What I find interesting about this, though, is that this is a moment for the church to decide. Do they want to lean into more of this Jesuit, liberal, progressive branch, or are they going to go to a more conservative marking? And they have an opportunity here. And someone in Washington, D.C. once told me this is the most important, ultimate whip count that you'll ever have in your life.
Looking for a two-thirds majority. The first vote will be this afternoon. We'll keep you updated on that. Let's turn back to our top geopolitical story. India and Pakistan trading military strikes, raising fears of war between the two nuclear powers. Joining us now is Bloomberg's Ruchi Bhatia, joining us from New Delhi. Ruchi, welcome to the programme. Let's just start with what either side is saying this morning, both on the Indian side and on the Pakistan side.
Well, this is really the escalation of hostilities between the two nuclear-armed nations. In fact, just a while ago, we got a statement from Prime Minister Shehbaz Sharif's office, who said that he has given a go-ahead to the Pakistan army, and they are ready to act against India. And this after India said that they had conducted military strikes in Pakistan and Pakistan-administered Kashmir. This, of course, coming in the aftermath of gunmen killing 26 people in India-administered Kashmir. One of the worst civilian crises and one of the worst civilian attacks that we have seen in the recent years. Of course, Indian side as well as the Pakistan side both engaging in tough talk. And this is, of course, not coming in at a great time because, remember, for India, we're in the midst of trade deals. We're talking about trade with the US. On the other hand, we just signed a deal with the UK just yesterday, and Pakistan, on the other hand, their economy is emerging from a crisis. The IMF board is set to take up the loans for Pakistan on the 9th of May. So this is not coming in at a good time. Analysts are, of course, worried about escalation of this crisis further. Having said that, India has, in its response, said that these strikes, the fact that they targeted these 9 particular locations, these strikes were precise and they were restrained in their response. But remember, remember, this is the deepest India has gone into the Pakistani territory since the 1971 war. So this is really not a good sign. These are signs of, there are worries of an escalation as far as this entire crisis is concerned. We had seen global leaders, including U.S. Secretary of State Marco Rubio, as well as the Russian counterparts as well, both reaching out to India and Pakistan, asking for a de-escalation of the situation, as well as calling for a peaceful resolution, urging both parties to look at a dialogue to come to some sort of a consensus. But having said that, there is, as I said, tough talk on both sides. This is a sign of escalation of the military conflict, and clearly the markets will not be taking it very well. We saw the Pakistani stock index today declining to a 5-month low. The Indian stock markets were also pretty weak in trade today.
Ruchi, we see U.S. officials imploring restraint when it comes to this conflict. What are we hearing from Beijing?
Well, China has condemned these attacks, and remember, as far as India is concerned, various people have asked India and Pakistan both to refrain from escalating this crisis further. But having said that, India has always maintained. In fact, there was a mediation offer from Iran as well, and India has said that that Kashmir is an internal matter of India. They will look to steer clear. So India has not responded on the commentary that came in from China as well. But given the fact that China and Pakistan have had close ties in the past, China has said that they are monitoring the situation very, very closely.
Richie, whenever you have two nuclear powers engaged in this kind of action, clearly people get nervous for obvious reasons. Back in 2019, I think we all remember a similar period of tension as well. Can you describe for us what happened that time around and why we de-escalated things so quickly and whether things are different this time?
Last time, when the incident happened, things moved very quickly. This time, India took a lot more time than 2019. Also, as I said, this time we've seen that the strikes were deeper into the Pakistani territory, and which is why this time the conflict that we're seeing is very different. Having said that, India is at a much stronger position at the current moment on the world stage as far as what it had back in 2019. So things are very, very different this time around. We're seeing tough talk from both sides. India has had vowed to punish the perpetrators of the Kashmir attacks, and now after India struck those military targets, through its military, we're seeing Pakistani side now readying to act as well. So we will have to really wait and watch out to see how it really plays out.
Ruchi, appreciate the update. Thank you. Ruchi Bhatia there of New Delhi following that tension between Pakistan and India. India calling the action precise, restrained and designed to avoid escalation. I'm not sure Pakistan seems it the same way.
No, they definitely don't see it the same way. And they're saying that they downed some of these Indian fighter jets. What you see, though, from the global community is that they want to have this restraint. There's also another brewing issue in behind the scenes. This is access to resources. India basically saying there's this water treaty, and they're basically saying they don't want Pakistan. They want to get rid of Pakistan from this water treaty. If that continues and there's drought, there's going to be a lot more tension within this region.
We'll keep you on top of the story right here on Bloomberg TV with an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. China's central bank cut its policy rate and lowered the amount of cash lenders must keep in reserve. The moves are meant to help stimulate the world's second largest economy amid its trade war with the U.S. The announcement came hours after China revealed it would hold its first trade talks with the U.S. this weekend. Meanwhile, Rivian says full-year deliveries will decline more sharply than it anticipated a month ago, citing the impact of tariffs. Still, the EV maker expects to achieve a modest full-year gross profit. Rivian stockpiled EV batteries from suppliers in Asia ahead of Trump's tariffs to ensure supply continuity. And Inter Milan is back in the Champions League final after a nail-biting second leg against Barcelona. Inter was seconds away from elimination before scoring the tying goal in extra time. They completed the comeback in the 99th minute to seal the win in the 7-6 aggregate victory. They'll face either Arsenal or PSG in the final. I can see why you were up late, John.
Yahira, thank you. Frame it. End the season. Everyone else should retire. We should just have a 7-game series of Inter versus Barcelona.
Yeah,
no one's going to beat that for the rest of the year.
This is it. Well, yeah, you kind of have kind of blown the energy that you have for this game, right? And basically, how much can you have left? Is this the same as watching the Masters for you, or is it completely
that's a different vibe. No.
It's not like they do
this.
This is too stressful.
This isn't like golf.
The Masters is sanctuary, okay? It's a sanctuary. Okay, San Siro's not that. I've been to that stadium many times.
Good job.
Yeah, nothing like that. Believe me. The sound yesterday, absolutely deafening. Just absolutely fantastic. Just fantastic. Up next on the program, the art of the deal.
We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Up next on the program, Francis Donald of RBC joins us next to talk through the economic risks going into the Federal Reserve decision later on this afternoon. From New York, this is Bloomberg. Bouncing back from a 2-day losing streak on the S&P 500, positive by 0.6% on the Nasdaq, up a similar amount on the Russell, up by 1 percentage point. Under surveillance this morning, the art of the deal.
We will sign some deals, but much bigger than that is we're going to put down the price that people are going to have to pay to shop in the United States. Think of us as a super luxury store. We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Sounds simple, doesn't it? Here's the latest this morning. President Trump remaining optimistic on tariff negotiations ahead of US-China trade talks later this week. Francis Donald of RBC writing, the uncertainty theme is the new normal. What really keeps us up at night is the potential for supply shortages or empty shelves, leading to extended demand-supply imbalances. Francis joins us now for more. Francis, welcome to the programme. A lot has changed. Certainly a lot has changed since the Fed last met on March 19th. How much has changed for that committee as they convene and put out a decision later on this afternoon?
Well, it seems like a lot has changed when you look at the headlines, but the data itself hasn't changed very much yet. And that is the big challenge for this central bank and all central banks globally, which is that it's too early for them to actually see material impact from a lot of these Washington policies and global policies that are occurring at the same time. So, John, I got to say, I can't remember the last time I spent less time thinking about a Fed meeting. Some of that is cyclical. This is a Fed that's indicated it probably needs to wait and see. But a lot of it is structural, and that is that will matter most to the U.S. economy isn't whether the Fed cuts 1, 2, 3 or more times this year. It's what happens with trade policy, what happens with immigration policy, and do we have some dysfunction in the supply chains that leads to more problematic developments this year?
Francis, that sets us up perfectly. 1:30 p.m. Eastern Time, we will have live coverage of that meeting that you could not care less about. I want to go to the theory that you put out there that I thought was really important, which is it's less important, this sort of binary outcome, recession or not recession. It's the idea of some sort of stagflation that potentially could be more pernicious for this economy. Can you explain why you think that's an important distinction to talk about at a time where most people agree the economy is slowing?
Well, economists get divided into two camps, especially right now. Are you in the recession camp or no recession camp? And technically, if you look at RBC's forecasts, we don't have 2 quarters of negative GDP back to back, although that's very much a real risk. Regardless, we have very slow growth with a rise in the unemployment rate and a rise in inflation. And sometimes I think saying, slightly negative GDP is probably indistinguishable from slightly positive GDP. What will be problematic this year for the United States is not
whether we get 1, 2, or 3 quarters of negative growth or slightly positive growth. What we're watching are some of these bigger trends. A potential labor shortage that's coming through. America does not need jobs. America needs workers. What's happening with that electrical grid, which is really feeling a lot of tension? Can we actually reshore manufacturing activity? And as much as, of course, all economists are concerned about the price increases coming from tariffs, our eyes are firmly on, is this going to create supply chain disruptions? And one of the lessons from 2020 is that when you start to mess with supply and demand dynamics within supply chains, when you have ships that stop coming to shores, it isn't a 1 month fix. Sometimes it can take months or years to recalibrate supply and demand. And so that's what keeps me up at night right now. Not just are we going to see a mechanical increase in price because of tariffs. All of those factors are going to be more important to the U.S. economy this year than whether or not you get slightly negative or slightly positive GDP growth. So recession, not the camp that you should be putting economists in. Look for those underlying themes that are really dominating their underlying narratives for the U.S.
Are you sleeping better knowing that the U.S. and China are talking or planning to talk, or do you think that it's too late, that those ships that have not been floating over to the U.S. already have really risked the idea of supply chain disruptions, as you were just talking about?
Well, we'll sleep a little bit better if we can all collectively, as investors, economists, financial watchers, realize that the worst of that uncertainty is behind us. But I'm of the view that this uncertainty has long legs, because it's not just about U.S.-China tariffs. It's not even just about the U.S. versus the rest of the world building that tariff wall. There's an enormous amount of policies that are still potentially very game changer for the U.S. economy that's impacting American and global companies. They have to do with the immigration policy. Are we getting deregulation? What does tax cuts do? Companies I talk to are asking me about SNAP benefits and student loans. There's an enormous amount of change happening under the surface. Meanwhile, as we know, assets are not moving as they typically do. Those correlations are breaking down. That's having an impact. And we're still missing some of what is the internal strategy coming out of Washington? So yes, it would be nice if we've seen peak uncertainty behind us. And as I always say, markets are second derivative beasts, so that will matter. But there's probably long legs and kind of deep tentacles on this uncertainty within the U.S. economy. It extends broader than whatever headlines we're going to get this weekend around U.S.-China trade.
Francis, even if we see the tariff rate come down from 145% and let's just say for argument's sake 60%, are you still concerned about supply shortages?
Well, absolutely. This is a structural recalibration of a trade relationship. And think about a business on the ground that is trying to figure out what is the right calibration of content that I should be sending to the United States. This is not going from 145 to free trade. This is still a wall that is being built around America that's going to require an extensive amount of recalibration. And this is the issue, is that we are undergoing a structural recalibration of U.S. trade with the rest of the world. That's not easy for companies to figure out. And so when I go to bed at night, I'm not looking at Fed commentary anymore. I'm tracking ships from China to the west coast of the United States, because that could be one of the core themes heading into this year, is what that calibration looks like and just how difficult it is to find the exact point of supply and demand meeting.
Hey, Francis, you're one of the best, and you're not alone. Francis Donald there of RBC with the latest. It's very difficult to forecast in this environment. Depending on what kind of company you are, it can be almost impossible. For the Walt Disney Company, check them out this morning. This is rare. Haven't seen much of this over the past few weeks. A beat and a raise. Thanks to the theme parks, thanks to streaming. And this from Bob Iger. We remain optimistic about the direction of the company and our outlook for the remainder of the fiscal year.
So Bob Iger comes back. I wonder how much succession planning there'll be in this discussion, because right now it seems like he's doing pretty well. They're looking at revenue that beat for both entertainment, for even the streaming division, as well as the ESPN go direct to market later this year. They also are building a new theme park. This is a business that seems relatively immune to some of the other discussions that we have. I want to hear the commentary at 8:30 a.m. Eastern about how much they feel the uncertainty from tariffs and global tensions.
Stock is up in the pre-market by close to 6%. We'll have more on that in the next hour. Coming up next, Priya Misra of JPMorgan, Bloomberg's Tyler Kendall, Geetha Raghunathan of Bloomberg Intelligence, and former Kansas City Fed President Thomas Hoenig from New York City. This is Bloomberg.
doesn't take a lot of good news to see this market pain trade higher.
I think the markets will see through a lot of this.
You just have to be patient and wait for the moments when favorite names show you opportunities.
It's a little difficult to see how you can really get that next leg up.
If you want to de-risk from the U.S., there's not some amazing oasis of, place to park your money.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 bouncing back from a two-day losing streak. On the S&P this morning, we're positive by around 0.6%. On the Nasdaq, up 0.6%. Also on the Russell, up by 1 full percentage point. Your day ahead, your week ahead looks like this. Later on this afternoon, a Federal Reserve decision and Chairman Powell news conference and tumbleweed. Hardly anyone's talking about it. Quote of the morning came from Francis Donald of RBC. I can't remember the last time I spent less time thinking about a Federal Reserve decision. The main event for many of you might be 10 a.m. Eastern time when we hear from the Treasury Secretary Scott Bessent on Capitol Hill as the U.S. and China plan talks.
This is what even the Federal Reserve is probably watching more carefully than each other's rhetoric, because they want to understand what the trade framework is going to be like in the United States. There has been a softening in terms of the rhetoric between China and the U.S. How long it takes to make some sort of deal remains to be seen. What is the status of some of those other deals with other countries also remaining to be seen. The Fed is just as curious and just as dependent on that as they are what they are looking at each other and discussing economics.
This is an important moment because it's the first significant step we've seen in terms of a sign of a thaw in this trade war between Beijing and Washington. But what you heard from the Treasury Secretary last night, and I'm sure he'll elaborate on this today when he's in front of Congress in this hearing, is that this is not a deal. This is a step towards de-escalation. So what does de-escalation look like? Well, if you ask Kellyanne Shaw, who sat at the table with the Chinese during phase one in Trump's first administration, she thinks potentially the rates could come down 145%. But where's it coming down to? That's the question.
You're on the money, I think. This is something we've all got to address going into the weekend. Talks about talks. These are talks to arrange negotiations. It's not the start necessarily of negotiations. And to do that, I think the Chinese have been clear over the last few weeks. If you want to talk about this, if you want real negotiations, those tariffs need to come down.
In the meantime, CEOs are saying it's really nice you guys are talking. So glad that you've taken some of the worst case scenario off the table. How do we plan? How do we decide exactly what to order? How do we know exactly when this is going to be alleviated with contours of even a concept of a plan? How do we even understand what the asks are that are feasible on both sides at a time when the Chinese government is clearly girding for potentially a protracted negotiation with a new round of stimulus? This is the reason why it is surprising to see that Disney come out and upgrade their forecast. And you see others like BMW saying things are looking softer, but this probably won't happen. How much as a consumer and how much as a CEO can you take any of this with any kind of definitive?
Well, there needs to be strategic uncertainty. According to the Treasury Secretary, he said everything's on the table. I'm never going to come out here and negotiate in public because that will mean we're losing leverage. But the reason why this is such a positive development in terms of thawing between Beijing and Washington is because the president has come out and said a number of times he's spoken to Xi Jinping, and everyone sits around the table and wonders, is that really tangible and true? Because the Chinese have said there's no negotiations or talks on any level. Well, now there are actually talks. So the direction of travel from here at least seems to be positive.
The range of outcomes is incredibly wide, and it makes it very difficult to set policy. Chairman Powell, over to you a little bit later this afternoon. Equity futures on the S&P positive by 0.7%. Early days, but a bounce back from 2 days of losses on the S&P. On that, we'll catch up with Priya Misra of JPMorgan in just a moment. We'll talk to Geetha Raghunathan of Bloomberg Intelligence reacting to Disney earnings, and the former Kansas City Fed President Thomas Hoenig counting down to an FOMC decision later on this afternoon. We begin this hour with stocks rebounding, investors optimistic as US-China trade negotiations are set for this week. Priya Misra of JPMorgan writing, we are in a giant game of chicken between the market, the administration and the rest of the world. Maybe great deals are just around the corner. Priya joins us now for more. Priya, good morning.
Morning.
Are they just around the corner?
I think that's what the equity market's hoping, not realizing or maybe hoping that that doesn't happen, that trade deals or even an agreement in principle with all our trading partners is incredibly hard. It's going to take a while. The administration saying this is strategic uncertainty, which tells you, remember when we were thinking maybe April 2nd was peak uncertainty? Well, okay, maybe it was peak, but we're not that much lower. This is a plateau of uncertainty that the economy, it's going to weigh on the economy. It's very non-linear. You can handle some time of uncertainty. When that just goes into weeks and months, And, Congress is also sort of dealing with the fiscal side. So there's uncertainty on immigration, there's uncertainty on trade. When all that uncertainty starts to weigh on the economy, I think the equity market's hoping, well, the deal's right here. At least we know they're talking. That's good news. We weren't sure if that was happening. But it's going to take a long time even to get that agreement in principle. So we don't know how long it'll take, and we don't know the end point. The end point is not where we were on, at the start of this year.
No question, it's a policy shock. The ECB's decided it's a disinflationary shock. They've cut rates. The Chinese have done the same thing overnight. The Federal Reserve, when they have to address the same question, what kind of a shock is it for them?
I think Chair Powell's going to have to master the art of saying nothing today. So what kind of shock is a great question. I think it's a supply shock, which is very hard for monetary policy to address. But the Fed really can't commit to it. It might morph, I think it will, from a supply shock to a demand shock. When you get prices going up and the consumer has to pick between dolls or anything else and services, do they cut back on services? The US is a service-led economy, but look at the data right now. If you take a step back, the hard data is okay. Payrolls are strong. Inflation is still above target. So I think and financial conditions have eased in the last month, or at least in the last few weeks. So I think the Fed will say we have no urgency. They've already cut rates. They've taken the preemptive steps. I think people are looking for them to be preemptive. They were already preemptive last year. They've taken rates down. We're at 4.5. They're going to keep it here until they figure out what's the shock, what's the policy offset. Do we get a big fiscal stimulus deal? In which case, they don't need to address the supply shock. So I think for the Fed, it's trying to I think clarify the reaction function. That's the most they can do. That look, if the economy slows down, we'll respond. We're not there yet. We're watching, like everyone else, we're watching everything and we'll respond appropriately.
The reaction function. This is really interesting to me because right now we don't have a clear sense of what the reaction function is and what data dependency means in a new world where data is incredibly backward looking. And this economy depends on people having $30, not necessarily $2. And when you start to have that come to fruition, how quickly could you see it manifest in the actual hard data as a demand shock rather than the much more quickly moving supply shock that translates into higher inflation that could come as soon as next week?
Right. So I think that's the question we're all grappling with. That, we've not seen it in the hard data. How long does it take? I don't think it's that long. I do think it's a little more delayed because we learned from the pandemic. Companies learned from the pandemic. Consumers, I've not done any early shopping, but people have. I think this front loading, you're seeing it in the data. You're seeing it in the trade data. You're seeing it in, companies sort of picking up or piling inventories. So the lag might be a little longer. What I'm watching is what do companies do? Do they pass on that cost? Do prices go up? Do we see it next week in CPI? If prices are going up, that's when consumers have to decide where do they cut back, because real incomes are not really growing. So maybe it shows up in prices first and then consumers start to pull back on demand. Or do companies say our margins can afford to take that price increase? And in that case, when margin compression starts to build, do they start to lay off people? So I think we're going to have to watch consumers. We're also watching companies. What do companies do? I think hiring freezes are happening. Do the layoffs start? And so it's the next few months. I don't think we're waiting till fourth quarter. I think the next few months you'll either see the consumers pulling back or you'll see companies trying to keep some margin and having to cut costs elsewhere. And I guess the interplay of that will show up in the economic data, which the Fed will respond to.
It seems like the Chris Waller reaction function is to look through the price increases and look straight to what could potentially happen with the demand shock, what could happen to the labor market. Do you expect to get a better sense of whether that's consensus today at a meeting that Francis Donald is going to sleep through?
I don't think we'll get such a clear signal from Chair Powell because and I think there's a little bit of path dependency. We just lived through a transitory supply-driven pandemic shock becoming a demand shock because we had a lot of fiscal stimulus and it fed through into wages and inflation expectations. So I think what we'll hear from Chair Powell is we haven't seen it in the data. We're watching inflation expectations. And so, which is why I struggle with them being preemptive. But I do think when they see that data, and I think it's a matter of months, they can be very aggressive. The Powell-led Fed doesn't necessarily move in 25 increments. They started hiking late and then they went in 75 increments. I think they're going to start almost by definition a little late because they're waiting on data that is lagging. But once they realize it, and I think that's what the market's pricing in. The market's pricing in a scenario where they don't need to do anything because maybe we get these quick deals, credible quick deals. Or the scenario where the economy actually slows down and the Fed then aggressively cuts. I think we're pricing in this bimodal distribution, which is why the rate market's pricing in these rate cuts. I think actually the market can price in more if you start to see that hard data deteriorate.
You say they're going to be late. I can think of one person who doesn't like people being late, particularly Chairman Powell. It's the President of the United States. That this afternoon is going to be somewhat interesting.
Absolutely. I think you're going to get a live drip feed on Truth Social of him jawboning, or potentially if he talks to the press, he's going to say Chair Powell is wrong and should be cutting interest rates, but that's not going to be new. We've heard this all along from the president. The one thing that he has come out and said is he does not want to actually get rid of him, even though he has in the past used the word termination.
Do you think this comes up in the news conference today, or is this yesterday's news?
I'm sure it'll come up. And I'm sure Chair Powell's prepared to say, we're apolitical, we're not even thinking about this. Because there is an argument, which I don't love, that because he's getting this pushback to cut, that Chair Powell may not cut. No, I think they're looking at their mandate. The mandate, I agree, it's backward-looking data, but the hard data is not suggesting that they need to cut here. So he's got an easy pass. I think it can get a lot harder if the unemployment rate starts to rise and inflation starts to rise. I think then he's going to have to explain why he's not cutting rates.
But juxtapose this moment in time to before the election when he cut rates. Why did he do it then?
I think, the labor market was showing signs of weakness. Now, I'd like to give the Fed credit that just because they cut rates, the labor market sort of recovered. No, I think turns out that was a sort of noise in the data. We had those 3-week payroll reports, and Fed funds was at 5.5. So they cut rates to take some of that edge off the economy, to move rates lower. They didn't need to do more. The long end sold off. So I think the market pushed back and said, no, you actually don't need to cut a lot more. The Fed heard it. So I think that, I don't think is political. He'll absolutely be asked that. But I think as long as he's not fired, I think it's a free country. People can push
It's a low
back
bar, Priya.
Right.
As long as he's not fired. Priya Misra of JPMorgan is going to stick with us. We need to talk about the bond market with her. Only last week, she said the 30-year bond was a risk asset. We'll talk about how risky this bond market is a little bit later this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. A check on Disney shares. Those are up 6% in the pre-market after reporting fiscal second quarter results that beat Wall Street estimates. Disney is benefiting from faster than expected growth at its theme parks and its streaming business. And because of that strong performance, Disney raised its guidance for the full year. Meanwhile, Shein and Temu both saw double-digit sales declines the week after they raised retail prices to cover the cost of U.S. tariffs. The duties are also having an impact on the company's business plans. Shein is slowing its IPO plan, and Temu is planning to switch to a local fulfillment model. And Transportation Secretary Sean Duffy says it's safe to fly into and out of Newark Liberty International Airport. This comes after air traffic controllers lost contact with aircraft for about 90 seconds last Monday. Speaking at the White House, Duffy said the agency will focus on improving traffic at the airport to give travelers more options. That's your Bloomberg Brief. John?
There's certain things that you don't want people in government saying, like when they come out and say the financial system is resilient. When the Treasury Secretary has to come out and say those things,
Bad news.
You should just assume it is already resilient.
Correct.
I don't want the Transport Secretary telling me that airports are safe. I just want to assume they're already safe. It's not a good position to be in.
Especially when it's a regular occurrence that has to come after people are receiving crisis counseling as a response to our safe air traffic control system.
Shocking. Absolutely shocking. Up next on the program, the US and China breaking the ice.
The world has been coming to the U.S., and China has been the missing piece. This isn't sustainable. As I said before, especially on the Chinese side, we don't want to decouple. What we want is fair trade.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall and get more thoughts from Priya Misra of JPMorgan on this bond market. Live from New York City this morning. Good morning. Looking to erase a two-day slide on the S&P 500. Equity futures so far this morning just about positive, up by 0.7%. Your scores in the bond market. Check out the 10-year. The 10-year, the last time the Fed met, March 19th, 424. Not far off that this morning, 431.40, yields higher by 2 basis points. No change expected. BNP Paribas, nothing to do. Morgan Stanley's Mike Gapen, the data says the Fed should wait. We mentioned Francis Donald of RBC. Can't remember the last time I spent less time thinking about a Fed decision. So that's your promo for this afternoon. Under surveillance this morning, the US and China breaking the ice.
The world has been coming to the U.S., and China has been the missing piece. We have shared interest that this isn't sustainable, as I said before, especially on the Chinese side. And, 145%, 125% is the equivalent of an embargo. We don't want to decouple. What we want is fair trade.
So here's the latest this morning. The first confirmed trade talks between the US and China set to happen this weekend in Switzerland. Treasury Secretary Scott Bessent seeking what he calls de-escalation. Joining us now is Tyler Kendall from the nation's capital. Tyler, welcome to the program. Feels like talks about talks. Is it fair to call them talks about talks?
Yeah, hey, John, I guess that's a good characterization of this because it really is going to be all about de-escalation before they can get into any real contours of a trade deal. And Bloomberg Economics cautions that they don't think meaningful tariff progress is really going to come quickly or easily. Now, of course, the optimistic view would be if both sides lower their tariffs on a reciprocal basis to start to jumpstart these discussions. But ultimately, we know that Beijing has called on the U.S. to remove or at least slash significantly its levies on a unilateral basis. And while President Trump has signaled some willingness to lower tariffs on Chinese imports as the current situation amounts to a trade embargo, ultimately, we know that this White House would like to see China de-escalate first. That could potentially look like China pledging to boost U.S. imports, perhaps resurrecting some of those purchase agreements under the Phase 1 China trade deal, maybe even perhaps tightening controls when it comes to fentanyl flows, loosening curbs when it comes to critical minerals, things like that. But at this point, it really does remain to be seen what the U.S. needs to see in order to move forward here to those official talks. And officials tell us that's by design, as Treasury Secretary Scott Bessent really contends it's all about strategic uncertainty. But, John, to be sure, the other side of this, of course, is that President Trump has threatened that he'll just set a rate and walk away from the table if he doesn't like how negotiations are going. Perhaps we got Beijing's response to that in a statement this morning from its Commerce Ministry, saying that they hope that the U.S. will engage here with sincerity and move ahead with what they called equal consultation.
Tyler, what do we expect from the Treasury Secretary today? He's going to be back on Capitol Hill yet again, but now with some fresh news behind him.
Yeah, no doubt. And no doubt that these lawmakers are going to also want to take a fresh swing at this administration's policies as we do get this update about trade negotiations. Now, he did tell lawmakers yesterday, laid out some goals here, saying that he hopes that about 80 to 90% of our top 15 trading partners will see trade deals by the end of this year. So that was sort of a new timeline that we hadn't heard before. So perhaps we could get even some more concrete details as this administration contends that we could see agreements as soon as this week. The second part of this, though, of course, is going to be about the tax agenda and reconciliation. He's going to be talking to these lawmakers. One of those themes that we are watching closely is whether or not we get any update when it comes to the X date. Treasury Secretary Bessent has said that updated number is forthcoming, but that they're still working through those April tax receipts. But that's going to be absolutely critical. As you know, Annmarie, that will likely serve as that hard deadline for lawmakers to get to that reconciliation package through that this White House is banking on.
Tyler, thank you for the update. Tyler Kendall down in Washington, D.C. Priya Misra of JPMorgan still with us. Priya, let's build on some of this and unpack it. So on March 19th, we closed around 424 on 10s. This morning, we're around 424 on 10s, despite the fact we had a major policy shock down in Washington, D.C. You know where this is going. Number one question for portfolio managers right now. For anyone who's cross-asset, is the long bond going to provide me some comfort if things go wrong with the economy?
I'm not sure about the long bond. I think the long bond has supply-demand for treasuries as much as the economic fundamentals of where Fed policy is going to be. The 5-year, absolutely. We've been adding any backup in interest rates. We've been adding to the 5-year. Concerns around deleveraging, we've been adding to the 5-year because that's much more levered to essentially Fed cuts and that end point. So we don't have to have necessarily a view, do they start cutting in July or September? What's the end point? I think it's going to be below that 3%. So the 5-year, I think, does provide you that hedge. I think it's a true hedge. The long end, now we're talking about supply, demand, what's the end goal of tariffs? Is it to remove the trade deficit? If it is to remove the trade deficit, the rest of the world doesn't need to hold as much in treasuries. I don't think that's the end goal, but I think the long end has a lot more supply demand. We're also talking about this reconciliation package. It's very hard to get the Medicaid cuts in there. So if Congress doesn't end up doing the cuts, but still manages to do all these tax cuts, beyond the extension, I think that's going to put pressure on the long end. If we have a politicized Fed at some point, inflation risk premiums can rise. So I think there's a lot more going on with the long end. I would stay away from the long end. We like curve steepness. But I think that 0 to 5 is still rock solid.
What has changed in the past month, or really since the last Fed meeting, that makes you that much less positive on the long end of the yield curve?
April 2nd.
Right, but what about it?
So I think the idea, and I think you all have talked about it, which I think was a great way of saying, is this a shock to the cycle or the system? And is this like a change in the US-led world order, trading order, economic order? I mean, trade is a lot of us have been talking about trade. The flip side of trade is that the rest of the world buys US assets. And if we're trying to reduce the trade deficit, it means that the net international capital position of the US is going to change. If the rest of the world doesn't need to own as much in US assets, cost of capital is going to go up. It's not just for companies and consumers, for the US government. And at the same time, what are we getting in terms of on the fiscal side? If we were getting significant fiscal retrenchment, I would have said, okay, demand's less, supply is going to be less too. We're not really seeing that. Now, the tax bill is being talked about. So I think April 2nd, I don't view that as necessarily just a negotiating chip and, we'll just get better fair trade deals and we'll go back to where we were at the start of this year. I think the administration's trying, and I think the damage is already being done. The rest of the world now sees the US not necessarily as a very credible trading partner. And therefore, should capital come back to the US, I think we have to do a lot of work to attract that capital back.
Priya, when it comes to the tax bill, does the Fed need to cut if we get all the sweeteners the president has promised?
Not necessarily, but do we get that? And I think that's why the Fed, and I hope Chair Powell's asked about that how does the tax deal, it's another form of uncertainty. They did see, what resulted in inflation becoming entrenched, I think part of it was fiscal, right after the pandemic. So if we get significant fiscal stimulus that can offset tariffs, the Fed can step back. I don't think we're going to get that, and the Fed will realize it, and then they'll have to cut more aggressively. But we don't know, and they don't know, and so they're just going to try and say nothing for an hour, which is going to be quite.
It's going to be fun, right, isn't it? Live on Bloomberg TV later on this afternoon. I'm pleased you keep going back to this framework. Is it a cyclical level shock, a cycle level shock, or a system level shock? I think it's really, really important. I don't know. I don't know how great the appetite is in Washington, D.C., to rewire the global system and tolerate the dislocations that could be associated with that. What worries me in between while we try and figure this out is whether international investors behave as if it is a system-level shock and begin to diversify away from US assets.
Which is the reason why the Taiwanese dollar and the fact that it surged caught people's attention. Taiwan is uniquely exposed because of how many US dollar-denominated assets that life insurers have bought, but also because of trade. Are they a leading indicator for what's to come?
Priya, this was really thoughtful. It always is. It's good to see you. Priya Misra there of JPMorgan, counting down to the Federal Reserve decision a little bit later on this afternoon, but not really. A lot of people just think this is going to be an absolute snooze later on this afternoon.
It will be a heavy lift for the journalists who are tasked with asking really good questions that will not be answered, but asking them in a way that makes it sound as though there is some progress being made, because right now there is no incentive whatsoever for these Fed officials and Fed Chair Jay Powell to say anything other than we're just following a world.
If you have to be glued to the TV today, it's going to be Scott Bessent on Capitol Hill. It's not going to be Jay Powell over at the Fed, because there's really nothing he can say, as we've all said. But the markets are dictating what they want to do based off policy. So you need to look what the Treasury Secretary is saying.
Looking ahead to the talks about talks later this weekend over in Switzerland. Up next on the programme, Geetha Raghunathan of Bloomberg Intelligence on some big earnings from Disney, a beat and a raise, and some optimism from a CEO, Bob Iger. We haven't seen much of that through earnings season so far. That name is up in a pre-market by 6%. Equities are doing okay. Stocks are positive across the board here on the S&P, on the Nasdaq, on the Russell as well. Equity futures on the S&P 500 higher by 0.6%. 0.6%. 2 hours away from the cash open. The opening bell just around the corner with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Disney doing some work to allay concerns of a consumer slowdown, increasing their guidance going forward. Also seeing strong results in the quarter that they reported. Their theme parks, for example, that did really well. Concerned there that there'd be some slowdown because of consumer uncertainty. They're also increasing the price of their streaming services. All of that coming together to lift shares 6.5%. Uber, kind of the opposite problem, not doing enough to allay concerns of a consumer slowdown. That's even though that they increased the guidance going forward. But it's really the quarter that they reported that has the concern. We did see a gross booking slowdown. Now, the company said it's really because of a strong dollar, but even at a constant currency, gross bookings were a 20% increase compared to 24% ahead. So shares down 3.33% this morning. Finally, wrapping things up with CrowdStrike. Now, they reported earnings about 2 months ago, and they were pretty week, still feeling the effects of that flawed software update that led to a bunch of servers going down across the world. Well, they gave a strategic update today saying that they're going to be streamlining operations, that they'd be letting go about 5% of the staff or about 500 workers. They'd face a charge of that of up to $52 million. Shares down 2.2%. Also not sure to make of this one, but the CEO also saying that offices would be closed today and tomorrow, and that if you're already in the office, you should probably go home. John.
Okay. Do we know why?
No, there wasn't really a reason attached to that. I don't know if it has anything to do with the layoffs or whatnot, but yeah, the CEO saying go home if you're in the office.
Interesting. All right, we're down about 2.2%. Things you don't want to hear. If you work for a company, right? Go home.
Maybe they're just saving electricity.
Sometimes on a
Honestly,
Friday,
I was about
that's
to
okay.
say, sometimes you want to hear that. It doesn't depend.
If someone says go home in the middle of the week, I don't think that's a good conversation.
You're going to say, please, sir, say. Well, I mean, this is a question about, maybe electricity bills, maybe.
Friday mid-morning, I'll take that. All right, watch this space. On a radar this morning, India carrying out targeted military strikes in Pakistan in retaliation for a militant attack last month in Kashmir. Pakistan saying it shot down 5 Indian jets in response.
So Pakistan is saying this is an act of war. I am looking at what Eurasia Group South Asia practice head put out this morning, and when it comes to what happens next. And that restraint we're hearing from the places of Washington, Beijing, maybe it's working. He said both sides are nuclear armed. We all know that, which is why everyone is concerned. But he says neither has overwhelming military dominance. Both lack the economic or political interest in a sustained conflict. So these skirmishes tend to die out within 24 to 48 hours. So I think potentially where we are at the end of the week potentially will show where this conflict is going.
And it's not a surprise that the U.S. administration is trying to tamp this down pretty quickly because there's enough going on in the rest of the world with trade tensions, with hot conflicts. This is not one that they really want to see percolate upward.
Yeah, 2 nuclear powers throwing missiles at each other.
Maybe let's not do that.
It's never a good look. Without this news, our next story, you would have seen equities weaker overnight following the last story. This one, though, is the one driving stocks this morning. Treasury Secretary Scott Bessent and US Trade Representative Jameson Greer heading to Switzerland for trade talks with China this weekend. The pair set to meet with the Chinese Vice Premier with a focus on de-escalating trade tensions.
Yeah, talks, maybe. And so we get now maybe the sense that things are at least softening. The idea of taking the worst case scenario off the table, how much is that good for? Right now, it's good for a slight rally in markets that have already seen a pretty big boost over the past couple of weeks. How far can this go, though, without greater contours, given the fact that we've already seen the likes of Temu and Shein already see sales declines? It's a real concern already in the works for a lot of companies.
What they're asking the Treasury Secretary, the President of the United States, is something that most economists argue is good for China. So maybe China will be willing to do these things, rebalance. Maybe they revisit the purchase agreements. I don't know. These all seem pretty easy to me. Fentanyl, address some of that. There was a report that the Chinese are willing to do just that. It's the Chinese demand to the US that I think might fall on deaf ears. And I'm thinking more specifically about restrictions around US technology. That could be the sticking issue. Not in the talks at the weekend. These are the talks about the talks, and maybe you have to move down the tariffs to take a step forward. It's the complete agreement further down the road. It's the sticking points in the complete, fully comprehensive agreement further down the road that we need to spend some more time thinking about.
And it's going to be the most challenging because that's what China wants, but that's what the U.S. refuses to give into. When Scott Bessent, the Treasury Secretary, talks about decoupling from China, he only wants to decouple in the national security space, high tech, steel, pharmaceuticals, things that matter from a national security perspective when it comes to the United States. But China wants access to all of that. So down the line, that's going to be incredibly challenging. Maybe we see the tariff rate drop at the end of this week, but it's going to be months till they get to something more comprehensive.
Companies like AMD putting a price on this, expecting to lose $1.5 billion in revenue this year due to U.S. restrictions on sales to China. The CEO, Lisa Su, remaining bullish about overall demand for AI infrastructure and counting on the debut of new chips to boost sales later this year.
Yeah, and the shares are up because they talked about the insatiable demand for chips and for AI types of technology that really keeps on going. AMD is the one competitor to NVIDIA, although NVIDIA is the big behemoth in this space. I just want to point out that Jensen Huang overnight was talking about how this is a Boeing-sized opportunity that's being lost for them in China. And he's not talking about one plane. He's talking about the entire company in terms of potential sales in China that is going to be eliminated with some of these chip constraints. So how do these companies portray optimism about the AI build-out while also being realistic about what kind of decoupling there could be between the U.S. and China?
And speaking of China and Jensen Huang, when I caught up with him briefly in Washington, D.C. last week when he went in before this meeting with President Trump, he talked about the fact that China is really not behind the United States when it comes to advanced semiconductor. He said they are neck and neck. They are almost right behind the U.S. But when it comes to wanting to make sure they can continue to sell their product, next week is going to be critical. When the president goes to the Middle East, the administration is weighing potentially rewinding some of the Biden administration diffusion rules on how many chips they can sell into certain countries. Potentially, there's going to be more buyers in the Middle East for NVIDIA semiconductors.
Corporate America facing a lot of risks. The Disney company, the Walt Disney Company, did something different this morning. They beat expectations and then they raised their full-year guidance. The stock is up by more than 6% and some optimism from Bob Iger. We remain optimistic about the direction of the company and our outlook for the remainder of the fiscal year. Joining us now to discuss is Geetha Raghunathan of Bloomberg Intelligence. Geetha, let's get to this optimism. What underpins the optimism at the Walt Disney Company that's absent elsewhere?
Yeah, it's really a strong report, John. I mean, the theme parks, I think, is, of course, the biggest contributor of both earnings and free cash flow at the company at about 55 to 60%. For them to come out and reiterate operating income growth for the theme parks at 6 to 8%, but more importantly, raise guidance, EPS guidance to 16% growth from a prior high single digits, just speaks to, I think, broad-based strength across all units. Of course, most notably at theme parks, as well as a lot of potential upside, I think, at the direct-to-consumer or the streaming unit, where they've projected about $1 billion in operating profit this year. But we think that can potentially go much higher, especially with the launch of the ESPN product a little bit later this year.
Geetha, it's important to point out that Disney shares are still down about 50% from their 2021 peak. So still a far place to go to climb back to the prior glory. What has Bob Iger done to turn at least the outlook around for a company that had been really beaten up over the past few years?
I think what Bob Iger did most notably, Lisa, is to really turn around the content unit. I mean, the content unit, especially the movies, were struggling with just miss after miss after miss. And then last year, after Pixar's, you had the Inside Out 2 come out, then we had kind of this whole revival in the studio. And now it's kind of, I think, really firing on all cylinders. So you have a pretty good lineup for fiscal 2025. But then you get into fiscal 2026, and the setup is absolutely brilliant as far as the studio is concerned. You have Avatar coming out a little bit later this year, and then they have a follow-up with, Avengers, and then you have a Star Wars movie. So the fiscal 2026 setup, again, is very strong. But it's not just, the movie business, right? It's across everything. It's across streaming, them cutting costs really, really dramatically. I mean, this was a unit that was losing about $4 billion just a few years ago, and they've really slashed their content budget very, very dramatically, I would say, Lisa. It was about $33 billion in fiscal 22. They're bringing that down to $23 billion this year. Again, being very disciplined when it comes to costs across the entire enterprise. I mean, whether that's sports rights costs, whether, again, that's content costs, whether that's marketing costs. So it's really many, many different things that Bob Iger has done across the board, and we're really kind of seeing that bear fruit. Execution, of course, at the fore, very strong execution.
Well, how do they digest this potential 100% tariff cost on movies produced overseas?
Yeah, so if you kind of think about the movie business, again, this is a very, very diversified media company. Yes, they are probably one of the biggest studios in the world. I mean, just a few years ago, they racked up something like $11 billion at the global box office. And again, movies are kind of the starting point for everything at Disney. But if you just kind of look at movies itself in the context of the entire company, they're about content sales and licensing makes up about 8 to 9% of total revenue. And if you look at just the theatrical business alone, it's much lower. It's about 5%. So I don't think it necessarily will have a huge impact. And again, we're really unclear at this point, Lisa, about what exactly this 100% tariff is going to be, whether it's just going to be on theatrical movies, whether it's going to be on streaming movies, whether it's going to be on TV production. So a little bit unclear, but I think Disney has still a lot of different levers that they can pull, and it shouldn't be as onerous as it kind of seems at first glance.
Geeta, the strength in theme parks is just amazing to me when we've seen all this weakness elsewhere in travel, particularly the airlines. Where's that coming from? Where does that confidence come from for this company?
Yeah, so they've been talking about seeing a pretty nice rebound in domestic park attendance. And even though during this quarter, during fiscal second quarter, we did see some weakness in the international parks, especially in China, I think they can more than offset that with domestic pricing. But more importantly, John, with really this huge investment that they're making in parks across, all their properties, they're adding more rides, they're increasing attractions. But most importantly, they're really investing very heavily in their cruise ships. And so we're seeing them. They actually just launched their 6th cruise ship late last year. They're going to be adding 2 more cruise ships in 2025. But basically, as you just kind of look out a few years, we're going to see them basically double their capacity, their cruise ship capacity. And that's going to get them to, I think, almost $9 to $10 billion just in revenue, just from cruise ships alone. So we're seeing them kind of really, add new rides, add new attractions, and that should keep the demand fairly strong, even though we do have a huge competitor coming up just in a few weeks with Comcast's new Epic Universal. So the fact that they're reiterating guidance just tells us about how much confidence they have in the outlook for that business.
Can you imagine a Disney cruise?
I'm looking it up
right now. Make that happen, Lisa?
Sure. So a 3-night Disney cruise from New York typically costs around $3,000 to $4,500 for a family of 4, and it includes enchanting entertainment, spacious staterooms, and Disney's private island. Relax in paradise with beach chairs, umbrellas, water slides, and a barbecue lunch.
Pay to watch John go on a Disney cruise.
That word relax is doing a lot of heavy lifting there.
Listen,
I don't know how much relaxing would be going on.
Listen, if you have a 2-year-old and a 5-year-old and they get sort of taken care of and they're happy playing in some sort of little waterfall and you could sit there with a drink, I mean, I think a lot of people would embrace that.
I don't drink, but I'd need a lot of drinks to make that work.
I think I could totally see you on this. Enchanting entertainment.
Geeta, I just want to finish on movies. Snow White bombed. And I just wonder where the good movies are coming from for this company.
Yeah, that was unfortunately a little bit of a misstep, but we do have a pretty good lineup. So, Thunderbolts just opened this past weekend, had a fairly decent opening. And then you just kind of look out a few months, John, and it looks pretty strong. I mean, you have Fantastic Four. And then you get a little bit later into this year, and then you have it's an embarrassment of riches, right? You have Zootopia 2, and then, as I said, you have Avatar, and then get into the next year, and it's just going to be absolutely spectacular with both Avengers and, the Mandalorian and Grogu movies. So they have a ton of that, things coming up. Very, very strong content pipeline for the Disney studio.
We'll certainly take an embarrassment of riches over an embarrassment. Geeta, thank you. Geeta Raghunathan there of Bloomberg Intelligence. Sorry for the hard turn. Didn't work out, did it?
That is quite something. All I can say is...
I apologise.
Okay.
All right.
I loved Zootopia. I
know you like that movie, yeah. I wasn't referring to that. I was referring to Snow White.
Oh, I'm perfectly aware of what you were referring to. And it's true that, it's better to have an embarrassment of riches than just an embarrassment.
Stock's doing better.
Have you actually watched it even?
Look, I didn't sleep last night. Disney's up by 6%. I'll be in a better mood for the Federal Reserve decision later this afternoon.
I can't wait
Let's
for
get
that.
you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The UK and US are set to be in intense talks over an agreement that would reduce some tariffs. Securing a deal with President Trump has become a priority for UK Premier Keir Starmer as he seeks to protect British industry from the impact of US tariffs, particularly 25% levies on steel and car imports. Meanwhile, a check on Uber shares, those are falling nearly 5% in the pre-market after the company reported gross bookings for the first quarter that missed estimates. The company's U.S. rideshare business was affected by factors including the LA fires, extreme winter weather, rising insurance costs, and worsening consumer confidence. And Catholic cardinals from around the world are gathered at the Sistine Chapel for a conclave to choose a new pope. The 133 cardinals will have no contact with the outside world during the process and will not be allowed to leave until they reach an agreement. Recent elections for Pope Francis and Pope Benedict were resolved within a few days. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, President Trump versus Chair Powell.
This is a perfect time to lower interest rates.
It's not clear at this time what the appropriate path for monetary policy will be.
We'll get into that tension next. We'll catch up with the former Kansas City Fed President, Thomas Hoenig from New York. This is Bloomberg. Talks about talks scheduled for this weekend in Switzerland between the United States and China, helping to lift this equity market. Positive this morning by 0.6% on the S&P, on the Russell, higher by 0.8. Under surveillance this morning, President Trump versus Chairman Powell.
We're focused on separating the signal from the noise as the outlook evolves.
This is a perfect time to lower interest rates.
It's not clear at this time what the appropriate path for monetary policy will be.
He's making a mistake by not lowering interest rates. He's keeping rates too high.
It's the latest this morning. The president pushing for lower rates as Fed Chair Jay Powell is set to keep policy unchanged. The former Kansas City Fed President Thomas Hoenig writing, the Fed almost certainly must leave rates unchanged. A stagflation outcome would be the most likely path. Thomas joins us now for more. Thomas, welcome back to the program, sir. Why do you believe that is the most likely path? Why do you believe the most likely path is stagflation?
I think, number one, the economy, while not doing great, is still stable. It was not bad in the first quarter. The imports brought it down a little bit, number one. Number two, I would say that the inflation shock from the tariffs is not clear, as Powell said, so you don't want to get too much ahead of that. I would also point out that there's also a reconciliation bill in the Congress that projects that we will have a higher deficit. We will have some decreases, not only continuation of tax cut, but decreases in some taxes that will be stimulative. And so how do they anticipate that? They have to wait and see to some extent. So I don't think they're in a position to be raising rates, and they know it. And I would tell you, finally, inflation is still well above target. And real rates, if you take the nominal rate of 4.25 and the inflation rate of 3, you have real rates of about 1.5%. That's not particularly tight. So those are all factors that have to be entering the discussion today. And the discussion today is about the future, I suspect, within the FOMC.
Thomas, I've got to be honest, most people who've come on the show today have not seemed particularly enthusiastic about this Fed meeting and are probably going to be listening while also reading all of the reports that they have to read for the following day. Do you think that anything is going to come out of today's press conference with Fed Chair Jay Powell, given the fact that he's waiting for the evolving data as there are talks and discussions about potential bills? I mean, it just seems like there is no incentive to say anything.
I think that's correct. I mean, why would he? He knows he can't change, or he shouldn't change rates lower. That's where the pressure is. He certainly won't raise them. He's going to be very coy because he does know we have inflationary impact. There are negotiations starting with China right now on whether or not those tariffs will stay higher or be brought down. That isn't clear yet. And we have a reconciliation bill that he can't figure out yet. So why would he say anything? He's not in a position to, since there's so much up in the air and so much uncertainty. He can't do anything but make it worse by speaking too much.
There is a belief in markets, though, that the Fed will probably be late and that there will then be pretty significant rate cuts at the end of the year, which is the reason why you've got about 3 rate cuts being baked into the market for the remainder of 2025. Do you think this is correct, or do you think that people are underestimating the Fed's resolve to get inflation back down to 2% in something of a more normal time frame, not necessarily the next decade?
Well, I think they're pretty set on getting inflation down. They're very familiar. They've studied it. They've talked about it about the 70s, where they similar situations. Should they lower rates? Inflation has come down somewhat. We see some pressure, and they lowered rate prematurely, and eventually got inflation up to where it was almost out of control, and they don't want to repeat that mistake. So they're going to be very cautious. I'm not sure, unless the economy really slows in the second half, probably the fourth quarter, significantly, or they see signs that it will, I think they'll wait on any rate cuts this year as long as they can.
So that's going to obviously irk the president of the United States. But he was recently asked about what he meant when he talked about termination. Would he replace Jay Powell? And he said, no, why would I do that? I get to replace this person in a short time, basically this time next year. Do you have any concern about Fed independence right now with this Trump administration?
Well, certainly. The independence is always an issue with the Fed. I mean, this is not new to Trump. I mean, Johnson did it. Certainly Nixon did it. So there's always that issue. I do think that who succeeds Powell will be extremely important, because there will be pressure on the confirmation process, or I should say the nomination process, for that individual to be very, shall we say, available to Trump, to hear his views on why they should cut rates, and primarily always be to cut rates. And I think that will be an extremely important choice that the markets will follow. And that will be the only, I think, discipline on how Trump selects the next chair of the Fed.
Thomas, as you know, as an expert of economic history and Federal Reserve history as well, history is littered with examples of tension between the Federal Reserve and the president. I just wonder, from your perspective, whether you believe this is somewhat different and what would make it unique for you.
Well, I think it's more intense. I think it's different in that sense, if you can reasonably say that. But this is Trump is in his face about lowering rates rather than behind the scenes where you usually see this happen. That makes it more public, and it puts, I think, the Fed and the chairman in a very bad position, because now, even if they thought, well, maybe we should lower rates this next meeting, they have to be more careful about how that's going to be perceived and how they build the case for that. So it's put more pressure on the Fed, actually, to stay, shall we say, appearing to stay independent, not only being independent. And that is, I think, a tough position to be in for Powell and the FOMC.
It certainly muddies the optics, that's for sure. Thank you, sir. Thomas Hoenig there, the former Kansas City Fed president. I'm sure that one other thing that might frustrate this president, if we get a deceleration in economic growth, can this Federal Reserve respond to it? If you go back to the update from the SEP, they put out these forecasts every quarter. The one thing that stood out for a lot of us around this table was the fact that they downgraded their assessment for growth for 25, but didn't increase the outlook for cuts implied by the median dot. And I took that away as quite a hawkish move from this Federal Reserve, just a signal that it might be constrained by upside risk to inflation further down the road.
Constrained by stagflation, constrained by the fact that inflation is going to ultimately tie their hands, which is what Thomas Hoenig was talking about. They are constrained by their remembrance of 1970s and their desire to avoid inflation getting away from them.
Coming up on the programme, the conversation continues. We'll catch up with Keith Lerner of Truist, Mandeep Singh of Bloomberg Intelligence, Tom Porcelli of PGIM and Vishal Khanduja of Morgan Stanley, as this market gets a little bit hopeful about talks this weekend between the United States and China. Talks about talks, Bramo, with the objective being negotiations and hopefully lower tariffs.
Doesn't it sound like fun? We're going to get to talk about talks about talks. We're going to talk about the evolving data as there are talks about talks that the Fed is going to be watching that nobody else is going to be watching, because right now people are not that interested. It's fascinating.
Welcome to 2025.
It's going to be so much fun.
The third hour of Bloomberg Surveillance, up next.
This is a Fed that could be on hold for a long time.
The economy is running okay right now. They don't want to get ahead of this.
Powell's going to be very hawkish.
The Fed's in a tough place. I'm expecting to hear not a whole lot.
The Fed's hands are tied to deliver the kinds of cuts that we've seen in prior cutting cycles.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away, and your scores look like this on the S&P 500. Equity futures at the moment bouncing back from 2 days of losses. We're up across the board on the S&P, on the Nasdaq, on the Russell this morning. On the S&P 500, higher by 0.6%. Going into a Federal Reserve meeting later on this afternoon, a Chairman Powell news conference that not many people are paying attention to at the moment, so look out for that. Earlier on, a few hours earlier, you'll hear from the Treasury Secretary, Scott Bessent, on Capitol Hill. That seems to be the main focus going into the weekend as we schedule talks between the US and China.
We are trying to figure out whether we are in a regime change when it comes to trade and how much that will have ramifications for the underlying economy, which the Fed has to respond to. What strikes me about this moment is that the market is used to responding immediately to fast-moving information, and right now we are in a slow-moving barge, literally, that is or is not coming over from China that could have dramatic ramifications for the overall economy. We are in wait-and-see mode at a time when a lot of people know big changes are coming down the pipe.
Well, it definitely is wait-and-see mode because the Treasury Secretary said this is about de-escalation. It's not about a deal. It's the very beginning, baby steps starts to potentially a bigger deal with China. What he says at 10 a.m. I think is going to be so interesting because yesterday, when he was asked about China, he said no negotiations are going on. And then late at night, we got word, the Treasury Secretary put out a statement that actually is going to Switzerland for trade talks. And by the way, the Chinese were also passing through Europe. They're also going to be in Geneva. So we decided we're going to have 2 or 3 days of talks. What he says on Capitol Hill is going to be very interesting because potentially we'll get a sense if they're willing to at least, at the minimum, bring down the 145% tariff rate to something, say, like 50, 60%.
Just to build on that, he's not going to negotiate in public at all. He pushed back against doing that just last night. But you can read between the lines. When he says things like, it's unsustainable, when the Chinese side says things like, we're not going to negotiate until you bring the tariffs down, I think that tells you that to really get these talks going at a higher level from here between the leaders, the tariffs need to come down.
It needs to be more than just talks about talks. It needs to actually be action. The question is, what are the nodes of negotiation? We know some of them in terms of what the U.S. has been asking for from China. We don't have a sense of just how much absolute bifurcation there is going to be between tech in the U.S. and tech in China, and that is going to be a main discussion point over the weekend.
Stocks are doing better this morning. We're positive by 0.6% on the S&P 500. Coming up on this programme, Keith Lerner of Truist on why he isn't rushing into stocks, Tom Porcelli of PGIM on a wide range of outcomes for the U.S. economy, and Vishal Khanduja of Morgan Stanley counting down to the Fed decision. We begin this hour with stocks bouncing back from a 2-day slide on the US and China trade talks as they're scheduled for this weekend. Keith Lerner of Truist is pushing back, writing, evidence suggests the near-term risk-reward profile is less favourable following the sharp market rebound. Keith joins us now for more. Keith, good morning.
Great to be here.
Just want to frame your year so far, just for the audience, because it's been pretty decent. You downgraded equities something like 5 days after equities topped out, all-time highs in the middle of February. You clearly think things have shifted again. The risk-reward profile has changed, given the aggressive rally we've seen off the lows. Where are you now?
That's right. Well, we are thinking that the risk-reward is somewhat less favorable. At the lows, when we were down 19%, we were telling our investors to start thinking about upside risk, not just downside risk, because at that point, you were down 19%. You were pricing in a recession. Well, largely pricing in a recession. At this point, as you snap back, we've kind of really priced in a good scenario going forward. So if I look at it, using this weight of the evidence approach, we still think the economy continues to slow down somewhat. Earning estimates likely have some downside. At the same time, when you look at the forward multiple for the market, you're around 20.5. At the peak, we were at 22. I would argue that given the uncertainty that we shouldn't be back at 22. And it's not just the tariffs. Don't forget, earlier this year when we were at the highs, we had DeepSeek come in. So on the margin, tech valuations should be somewhat lower than they were as well. So putting that all together, it doesn't mean we have to collapse. It doesn't mean we don't have some headlines to get this market up. But we think the upside is likely capped around 5,800 on the upside. Maybe you squeeze because sentiment is still relatively negative. That's the biggest asset for the market right now.
There's information in the headline. There's information in how the market responds to the headline. Yeah. What do you make of these moves this morning in response to the scheduled talks this weekend?
You know, as we were talking a little bit earlier, I think a month ago, this would have really moved the market much more. I think, we've moved up a lot. So some of this is priced in. The market is pricing in that we're going to get some tariff relief. But the question that I think we're all wrestling with is how much damage has been done. And we still think, look at U.S. GDP estimates. They would come into the year above 2%. They're at 1.3, 1.4. And then globally, you're seeing GDP estimates come down for China, for Europe, for the UK. So it's not just a U.S. story. So I guess the challenge I have is that at this valuation levels, even if forward estimates stay somewhat resilient, you saw that with Disney this morning, you're still trading at a pretty hefty multiple, and we still think there's some downside. Trying to keep an open mind what could go right, and the tech side is something where we've seen spending still pretty healthy, so that's a good story. But at this point, on a shorter-term basis, we just think the risk-reward is a little bit less favorable.
Keith, President Trump's maximalist approach on April 2nd, this Liberation Day, that chart that came out, then continue ratcheting up on China, 145%. Did he cushion the market to then be able to absorb whatever rate he ends on, whether or not it's 10% tariff ring and 60% on China?
I think so. I mean, if you think about where we are right now, we're 15% above that low from early April. So we have a big cushion to get back down there as well. So I do think, listen, you come out with the most aggressive stance, you pull it back. But again, the market at this point, when you've come back and where valuations are, I would say that the market is certainly expecting some tariff relief, but are we not going to see some slowdown? Businesses still are somewhat frozen. And I guess the other thing we've been wrestling with, too, is there is a difference between the economy and the stock market, right? I mean, the economy, small and middle-sized businesses that we talk to are more concerned. The bigger companies are able to manage this somewhat better, and we all know that the S&P 500 is much more of a growth index with 40% plus in tech and communications. So there's this offset. That's why I also think that low is a pretty good low, because the technology earnings, unlike the overall market, are still moving higher at this point. So
where are you seeing opportunity then? If you are, sounds like tech companies, yes. It sounds like Russell 2000, no. It sounds like there's a real question, though, about bonds as an offset, about gold. It seems like structurally we have changed the assumptions since April 2nd for at least some portfolio managers.
Yeah, early in the year, back in February, we did downgrade small caps, so we're less favorable for some of the things I mentioned. They are cheap, maybe a bit oversold. From a sector standpoint, because of the back and forth and the whiplash, what we're trying to do is we have a mixed sector approach. So we have our favorite technology or growth play is communication services. You're seeing that with, not only like the Metas and the Googles of the world, but also, as we saw with Disney and Netflix. So there's some kind of secular growth there. Our favorite defensive area is utilities, but there's also a secular story there with AI, which we're seeing actually the last couple of days. And on the cyclical side, we're favorable on financials. And our view is instead of trying to move back and forth each day with these moves, have your favorite area of defensive growth and cyclical as well.
You said that your ceiling was about 5,800. What's your floor?
I think the floor is likely that low, that 48.35, and maybe we find support before that. Maybe 5,100, somewhere in that neighborhood. And again, keep an open mind. I think that floor is good as long as you don't go into recession. Our house view is we're around 50-50, which is, that's where we're basically at. And you did have, the VIX spike and the sentiment that you normally see at bottoms. And the question is, do you just V-shape right to new all-time highs or come back down? And we do think the Fed is somewhat constrained.
This is the big issue we've all got as investors right now. Can the promise of deals continue sustaining this equity market? And is there a risk that between now and whatever the deal looks like, we hit an air pocket in the economic data? And if we do we have a good understanding of what is defensive in this equity market? Can you help us answer all that?
Yeah, sure. Well, I have all the answers for us today. I think the biggest thing, as I'm thinking about, again, I always think about, because we're a bit more defensive, what could go right as well. Is the market going to look through this as a short-term hit, right? If we're buying in companies, we're really buying them for the next 5 and 10 years, and that secular story of AI is still there. So I guess the question is, will the market see through some short-term pain, or at least a reduction in growth? Listen, the market is a discounted mechanism, but at the same time, almost have to see it to believe it. So I actually think that will constrain the upside. And listen, if we come back down and we think that we're past this, we'll likely look to maybe upgrade stocks again, but we're just not there based on the risk reward at this point. By the way, I'm not waiting for clarity. I'm not waiting because everyone says, hey, we want clarity. By the time clarity comes, the market has moved. But I'm looking for a better risk reward. And from an asset allocation standpoint, we're not saying to go like 30% cash. We have a little bit more cash. We have a little bit less equities. We still have high quality bonds, which actually have been acting well. We upgraded investment grade bonds on the spread widening recently. We've been bullish gold all year, though I will say short term it's a bit extended as well.
We've seen an aggressive rally off the low. That's the number one question for me, Lisa. Can we keep this equity market grinding higher? Can it be sustained just by the promise of deals? And can it be sustained by the promise of deals even if you bump into some weak, hard data?
A lot of people say that's the ultimate check. Hard data. When it actually does roll over, that is going to be what ultimately could check this sense that we've seen in the markets. I'm wondering about foreign demand and how much that changes in the meantime, how much there's been a structural shift for dollar-denominated assets that coincides with potential hard data that does roll over.
Keith, let's finish on that. Priya Misra talked about this earlier on. We keep going back to this framework. Are we seeing a cycle-level shock or a system-level shock? And if you're still trying to figure that out, do investors abroad behave as if we are seeing a system-level shock and begin to diversify away from dollar-denominated assets? Is there a risk of that playing out? Do you see signs of it already playing out?
on the margin, but I don't think there's a wholesale change. I think there was kind of this abrupt change initially. But the way we're thinking about it from a portfolio standpoint, we've been Team USA for several years, and we still have a slight U.S. tilt, but it's like an accordion. You have more different, you have different scenarios happening. You have the currency moving a lot. We bring in our bets in. We've been doing that since last fall. We added to EM a little bit. We added to developed markets this year. I mean, it is notable that on this V-shaped recovery, while the U.S. market's still below the highs, Europe's back to all-time highs. European financials are all-time highs. The other thing that's interesting, if you look at the returns, for international developed, they're up about 12%. Almost like 9% is the currency on that side as well. Longer term, though, we still say, where's the best companies in the world? They're still in the U.S. So we have that battle. But I guess the bottom line is stay with the U.S., but bring in those bets. And I do think there is some signal in that the recovery has happened quicker overseas.
It's still exceptional. What did Mark Rowan say over at Apollo? It's just not hyper-exceptional anymore.
It's heading down to just exceptional. And yet, what does just exceptional look like after so many decades of the U.S. being exceptional when it comes to the currency, when it comes to its funding markets, and then, of course, when it comes to tech development?
A lot has changed since the Fed last met on March 19th. One of the bigger changes in foreign exchange. Euro-dollar was trading at 109 this morning, 113.61. Keith, it's good to see you, sir. Thank you.
Thank you.
Keith Lerner there of Truist with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Disney shares are rising more than 7% in the pre-market after reporting fiscal second quarter results that topped estimates. Disney is benefiting from faster than expected growth at its theme parks and streaming business, which led it to raise its full year outlook. Disney also just announcing it will launch its first Middle East theme park in Abu Dhabi. Meanwhile, Treasury Secretary Scott Bessent and Trade Representative Jameson Greer will hold talks with China's Vice Premier He Lifeng this weekend in Switzerland. These will be the first confirmed talks between the two countries since President Trump announced tariffs of up to 145% on Chinese imports. And Tesla's China-made shipments dropped again for the 7th consecutive month. The EV maker shipped just over 58,000 Model 3 and Model Y vehicles from its Shanghai factory last month. That's a 6% decline year over year. In China, Tesla faces strong domestic rivals such as BYD. That's Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the programme, the Morning Calls. Plus, Mandeep Singh of Bloomberg Intelligence as trade barriers weigh on chip makers. From New York, this is Bloomberg. So the opening pair is about 1 hour and 14 minutes away. Equity futures at the moment firmer by just 1/3% now on the S&P. And I just want to sit on that just for a moment. As we said just moments ago, you can learn something from the headline and how the market responds to the headline. And Keith Lerner of Truist making the point here, Lisa, that maybe there's something to be said about this market only running 1/3% in the face of something we were all hoping for over the last several weeks.
This is a market that is realistic about what can get accomplished and has been trying to price in how companies can adapt and adjust at a time when there definitely are going to be higher tariffs. The fact that there is any rally gives you a sense that the worst case scenario has been taken off the table. Doesn't speak to necessarily what this market's pricing in.
Also, it was weeks ago when the Treasury Secretary told me in Argentina that these rates were unsustainable. So it felt like the market was already starting to price in the fact that the rate on China, that 145%, is bound to come down. We've heard that from a number of officials from the White House. Now we're going to have talks of it. So the market is taking this in stride. It's optimistic, but they know that this is not the grand bargain and the full deal.
Can the promise of deal keep sustaining this equity market rally? Can it? Right now, you've got an answer. We're up 1/3%. You'll get more answers in the days ahead. I think this market now wants some evidence of actual deals, a change to policy. Let's get you some morning calls. That's the price action. First up, Barclays raising its price target on Marriott to $252, saying its luxury and group mix is resilient in today's backdrop. Your second call from UBS raising its price target on Rivian to $13, saying there is a, quote, air pocket for the stock until its new car launch next year. That stock is down by 1%. And finally, Bank of America upgrading AMD to buy, seeing potential for it to deliver 20% or more top-line growth this year and Next. That stock is up by 1.2% this morning. Let's stick with AMD, the chip maker, saying US restrictions on sales to China will cost it $1.5 billion in revenue, despite an otherwise upbeat outlook. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good morning.
Morning.
They're putting a price on it. Have others too?
Well, I mean, 1.5 billion, when I look at, the overall estimates, it's down 3% from what they would have done otherwise. So to me, second quarter guide, 700 million write down because of the China impact. It tells you that the numbers, at least the top line and the bottom line, aren't going up. There is an impact. And look, AMD executed well, but the numbers were going up until now. So that is what has changed in terms of this market is AI is still that secular trend, but you're not seeing the lift that you got from, better execution and AI before. And that's where I think companies will struggle, whether it's NVIDIA or AMD. And
two separate things to think about here, tariffs and ultimately restrictions.
Yeah.
We're focused on tariffs. Management teams outside of this industry assume that tariffs can be negotiated. Do management teams in this industry assume that restrictions can be negotiated, or they believe they are the new rules of the game, the new laws of the land?
Well, so Lisa Su last night said the total addressable market is not changing. It's still 500 billion, and they think even if they're not able to sell in China, they'll be able to make up somewhere else. Now, my question is really, what surprised this market was you had training, inferencing when it comes to AI, and all these models keep getting released, which is good for compute requirements. It's just that if China is able to manage DeepSeek and their models without using any of the chips from NVIDIA, AMD, or any of the chip makers here, it tells you that the moat isn't as strong as everyone believes it to be. You can do it on Huawei chips. They are able to make chips that serve as an alternative. And that's where I think there is some figuring out to be done when it comes to, how much is this demand sustainable? How much of growth rates can sustain in 2026 and 2027? Right now, those comps look very tough when I look at, the companies have confirmed their CapEx numbers for this year. Everyone has said they will spend, in aggregate $350 billion across the 5 hyperscalers. So that's good. But the growth rate next year, nobody knows.
Mandeep, though, how credible is that they were able to do this without access to U.S. high-tech chips?
Well, I think it is credible. Imagine how else are they training the models? The models have been open source. They are being used to develop AI agents. And even if there was a pull forward in demand and, they got NVIDIA GPUs and AMD chips and piled them, but look, they are constantly serving the models. These models are being used for inferencing and AI agents and production use cases. So to my mind, this is not a one and done thing. This is continuous. And that's where the demand is more sustainable. It's just they're able to overcome the supply hurdles that they had before.
Jensen Huang spoke about in Washington, D.C., how China is really very close to where the United States is. This race, are they still even behind us?
Well, so, when I compare them to OpenAI's O3 model, what they just released, it's great. If you play around with Gemini and OpenAI's latest models, they may not have the latest multimodal functionality that everyone is looking for in these models because they keep improving every 3 months. But at the same time, when it comes to text-based chatbots, their models are equally good. That's why DeepSeek had such a huge adoption when it was released. So clearly, they are making progress. They're not at the cutting edge as the OpenAI and Gemini models are.
I'm really struggling to keep up with the narrative shifts because on one hand, you've got the U.S. versus China and technology. On the other hand, you've got tariffs and restrictions. And then on the other hand, you have what we were talking about 6 months ago, which is the AI adoption that was going to be insatiable and where there wasn't enough supply to meet the demand and investment was going through the roof. What happened to that part of the equation, overwhelming the other two?
Well, so I think there was a shift post DeepSeek. That was the big moment this year where everyone was so fixated on training, how big the next version of the model is going to be. Now it's the inferencing piece, which is really using the models in a different way. You're applying more reasoning capabilities. And with reasoning, you don't need to build, 1 million GPU clusters. You can do away with smaller clusters and use the inferencing, which is what OpenAI is doing. So that shift, along with the fact that they can't sell to China, and now the cost base is changing, because what if AMD has to make their chips here in the US? the cost base changes, the margin profile changes. So I can't see any margin upside for these companies, given the hand they have to deal with right now, with all these three variables that I just mentioned.
That's not a great assessment. Have you been following CrowdStrike this morning? I'd love your thoughts on this. If you're just joining us, so they're cutting positions, and they've said this to their staff today. Offices will be closed May 7th, May 8th. Please plan to work from home. If you are already in the office, I encourage you to head home for the rest of the day. What do you make of this communication from the company?
I mean, it is a surprise that they are asking everyone to stay home, but it's not a surprise that, every company is looking at how efficient they can be in terms of just, the operational side. And look, the AI wave is impacting how these companies are changing their workflows, whether it's a tech company like CrowdStrike. So we'll learn about more details, but clearly it is sending a signal.
So you believe, and I think this is an important distinction, you believe this is an efficiency drive driven by technology and not necessarily by a weaker demand backdrop?
A little bit of both. I can't say, because look, even with chips, we know there was a pull forward in demand. There has been a pull. Apple didn't acknowledge there was a pull forward in demand, but look, everywhere you look at, there was this risk of tariffs impacting, driving up the prices. So I do feel there has been a pull forward in demand, but clearly there is that efficiency side, which we'll learn more from all the tech companies. I'm just surprised that it's coming from a cybersecurity company out of, all the areas.
Where were you expecting it from?
Well, the larger the company is, like a consulting company, IBM or Accenture, if these companies would say, oh, we are getting different types of projects, so that's where we are going to hire that kind of talent first. So that's where I was expecting, depending on the size of your employee base.
We've said it now for a number of years, Lisa. We've been waiting for that headline to drop from one particular industry, not just tech, but also from finance too. At what point do you start to see these cuts, larger cuts, and not because of the demand backdrop, just because of this improved technological efficiency? You hear talk of it. We've yet to see big cuts in the way that maybe we're going to start talking about.
When we can say, hey, Siri, book my meeting. Hey, Siri, by the way, find a good restaurant for me. Hey, Siri, tell me where I should entertain my client. And hey, Siri, can you potentially end up coming up with some sort of proposal for me to give to my client this afternoon? And my phone is going absolutely bonkers as I speak.
Oh, do you use Siri?
I don't use Siri, but it's trying to get me to.
Oh,
and
right.
It's just got that bubble.
Because I was going to say, I mean, if that's how we're all going to operate, that would be great news for Apple, because no one really uses Siri, do they?
But it's just, my phone's just freaking out. It's so excited that it's being engaged. I'm sorry. Actually, you can go back to sleep.
When you're on air, Bramo, don't use Siri, just in case. All right? Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. Appreciate it. It's good to see you. Several Tories to keep on top of. Got to keep on top of the Federal Reserve as well, regardless of what people are saying about it. Apparently, it's going to be an absolute snooze. So Tom Porcelli of PGIM is going to join us to break it down. And then we'll get some reaction from Vishal Khanduja of Morgan Stanley. As we count you down to that Fed decision, lots of questions about the bond market. Will the bond market be there for you in an economic downturn? Let's make it simple. Will the 10-year Treasury rally if the data heads south? This morning, yields are higher by 2 basis points. The 10-year 4.32, the 2-year up 3 basis points to 3.81. From New York, this is Bloomberg. The opening bounce 60 minutes away, and equities are firmer by just 1/3 now on the S&P. The gains are fading. On the Nasdaq, higher by not even 0.2%, even as we schedule these much anticipated talks between the US and China. Maybe the clue there is much anticipated. We've been waiting for this and rallying on it over the last few weeks. With 60 minutes until that cash open, with your morning movers is Danny Berger. Hey, Danny.
Hey, John. We had Disney reporting earlier in the morning, helping to allay any fears of a consumer slowdown. They increased their guidance for the year and increased the price of their streaming services. As for the quarter, they reported that was also strong. They were able to beat when it comes to things like their theme park attendance. They also announced after their earnings that they'd be opening up a park in Abu Dhabi, licensing the IP. Can only imagine how hot that would be to walk around. Regardless, shares are higher by 8.6%. Now, we also heard from Uber this morning, an opposite story, and concerns here about the consumer. That's even though they increased their guidance, is because the quarter that they reported was weaker than expected. And there's this fear that consumers are pulling back on the ride-sharing app because of the economic environment. Now, they said it was because of a stronger dollar, but even at a constant currency, it was weaker than expected. So shares down 3.6%. Finally, wrapping things up with CrowdStrike. They already had earnings about 2 months ago. Those were also weaker. It was that software update that caused that glitch across computers and servers everywhere that was weak. Well, they had a release today announcing a new streamlining, changes that they were going to make at the organization. They're going to let go about 5% of their workforce. That's about 500 people. Shares falling 4 1/3%. And just an update on this, I mentioned in the last hour that they're closed today and tomorrow for their offices. It does seem that it's going to be tied to the fact that they're letting people go because they said they're going to start those conversations in the next few days. So if you are one of those few people who are asked to come into the office, it might not be a good thing, John.
Danny, thank you. Our thoughts are with them, that's for sure. Never good to see headlines like that, regardless of the company. The stock is down at the pre-market. The opening bounce about 60 minutes away. The Federal Reserve decision later on this afternoon. Most economists, almost all economists, expecting them to keep rates unchanged despite the pressure coming from the White House. With more, here's Mike McKee. Good morning, Mike.
Good morning, John. I feel a little bit bad talking about this, so I got to start out by saying that the Fed Decides on Bloomberg Television at 1:30 this afternoon with John and Lisa and Tom Keene is going to be riveting TV, must watch. You have to look in, but you're not going to learn much. The Fed isn't going to change interest rates today. Nobody expects that. And we're not going to see any new economic forecasts, and there's no new dot plot. So what is there to look forward to? Pretty much nothing but Jay Powell's news conference. And what are we really going to get from him at this point? What kind of guidance does he want to give? Not much. He'll be saying we can afford to wait. The economy is in pretty good shape right now. And it's better that we are late to move because of tariffs than we start off by moving in the wrong direction. And then, of course, everybody will ask about the president and his comments about the Fed, et cetera, and I'm sure that Powell will fall back on his, I'm not going to comment on that. So I'm not sure where all this leaves us at 3:45 when the news conference is over and you guys have to wrap it up. I'm sure everybody will be looking at Fed funds futures, but I just did want to point this out. They're kind of useless at this point. There's almost no point in looking. This is July, which is right now kind of where the first move is priced in. Look how volatile that is. Every time there's a new data point and every time the president opens his mouth, those move around. I don't think the White House knows. I don't think the Fed knows. Nobody really knows what's going to happen going forward. And so we all go into this mystery together.
Mike McKee, nobody's got a clue. Appreciate the update. We'll have more from Mike in just a moment. Tom Porcelli of PGIM Fixed Income has this to say. He's got thoughts. What started out as a year that could have been easily achieved trend growth has now quickly deteriorated. We will be lucky to see growth in the 1% range. Tom joins us now for more. Tom, good morning. Good to see you.
Good to see you all. How's everyone?
Very well. Been very busy since we last spoke. A lot has changed since the Fed last met. March 19th, they put out an SEP. Yep. And in their SEP, their forecast for growth for this year, for 2025, was 1.7%. And that was a downgrade from the previous forecast. And we all sat around the table and said, well, look, compare that to where the median dot is. They've downgraded their assessment of growth, and the median dot is unchanged. They've not increased the outlook for interest rate cuts. My question to you, if they put an SEP out today, and one is not due, but if they did and had to downgrade that GDP target 1.7% down to, say, 1%, what would the median dot do?
So they would be in good company if they downgraded it to 1%. The median dot, I think, would not move. And I think this really sort of drives home where they're leaning, right? I mean, in terms of dual mandate, it's entirely about inflation right now. And the irony, of course, is I think the administration is sort of, as much as they desperately want the Fed to cut rates, I think all that's happening is actually it's just going to sort of force that day out even further. So we expect cuts this year, but we just don't expect them, immediately. I mean, we don't expect. I think even July is actually looking a little too early for us. So I think it'll be more backloaded. But I think that there's no question that if you have inflation above target, if you have inflation expectations that are starting the process of becoming unanchored, and if you're now waiting for the inflation thrust from tariffs, I think that this really sort of pushes the Fed to the sidelines.
Can you help us out a little bit? No one knows anything about anything. These Fed officials have actually been going around the country listening to business leaders and talking with people. The whole Fed listens idea.
Yes.
Are they gleaning any more information about the stasis in C-suites, the idea of what companies are doing and how that could trickle into the economy?
Yeah, I mean, honestly, it's littered in the Beige Book. right? I mean, in the beige book, you can hear this. In the ISMs, you can hear this. I mean, anything that actually has some sort of like, sort of qualitative sort of assessment attached to it, we hear it loud and clear in all of these reports. Now, I think this gets to a really important idea because Powell keeps on saying, hey, but, the soft data is, sort of softening, but the hard data remains firm. Okay, but at some point, the soft becomes the hard data. And I think we have to sort of recognize that. It's funny. I think the last few years have really done a disservice to this entire conversation because there has been a divergence between the hard and the soft data for reasons that are pretty clear, right? I mean, which I'm happy to elaborate on. So I think if you just lop off the last few years and you look at the hard versus soft data historically speaking, they do move together. So I think it's just a question of time now before it sort of translates.
Neil Dodd has put out there this idea that hard data is getting inflated by the pull forward effect.
100%.
And there's this feeling that you really have to look at the soft data, which is a much more accurate reflection now than, say, a year or 2 years ago. If that's true, why are you less worried about some kind of real pernicious outcome for the economy, given how negative the soft data has looked? Yeah, so
which is why we've taken down our growth expectations. I mean, and not just taken down our growth expectations, but raised our recession probabilities. I mean, it's a coin flip right now, whether or not you have a recession. We still expect economic expansion to continue at a much slower pace. But I think, we are taking that to account, I think, in a very meaningful way, recognizing that the downside risk, I think, is growing seemingly by the day.
Coin flip based on what? What's the catalyst? Whether or not credible deals get done with trading partners?
I think the window is closing rapidly. I think if you don't start to see some real deals, which again, seemingly they're teeing that up right now, I think that the confidence that's already been wrecked, I think remains that way, and people and companies stay on the sidelines. And I'll say one last thing on this, because I think it's such an important idea that I think everyone's missing. Let's say you do get credible deals. And if you have the threat of tariffs that remain in place even after the deals get done, which I can easily see a scenario like that playing out, then I think that just actually keeps already crumbled confidence pretty suppressed.
This keeps going back to the theory that maybe we've started a process. Yep. The process has started and it becomes self-fulfilling. What is on your dashboard beyond just, say, volume going through the port of LA? Yeah. What's next? How do the dominoes fall?
Yeah, I think it gets to exactly this idea that we were just talking about. I think the dominoes have to fall, and I think this is the most critical domino. It has to be, okay, tariffs are done, right? Like, we've achieved what we wanted. Because if you keep the stick of tariffs out there, I think that the uncertainty that everyone keeps on talking about will just remain in place.
There's a price for that uncertainty. And right now, that price, Lisa, is wait and see. A lot of companies, to your question, are just sitting there on their hands and saying, got to wait and see.
Yeah. In the meantime, though, they have to raise prices. So they might wait and see when it comes to their investments. They might wait and see when it comes to hiring people. But some of them, at least, have talked about how they can't wait and see when it comes to at least passing along that price increase, which is the reason why you might see that inflation aspect reflected faster than anything else.
And actually, can I make one last point?
Sure.
I know that's like the cue for you wrapping it up. So I think...
How did you know?
I know your tricks. So I think... Just keep in mind something to this really important idea. If all of a sudden you start to see margin compression, right, profit margin compression, then the labor part of that equation becomes even worse. I mean, look, we're already expecting labor to slow down, and there's already signs that that's happening. That would make it, I think, meaningfully worse.
I had one more question. Serious and ready to go. Mike McKee says this is going to be really boring. How could you make this interesting, this news conference? What would you ask the chairman?
So I think that this would be one of these events where I'm guessing Powell would love it if there was no press conference attached to this. I don't know that there's anything more that he can say that's new. I think, and in fact, in fairness to him, I think he's doing the right thing. I think he's basically saying we're wait and see mode to see what happens, and I can live with that narrative.
We know each other too well. Go away. Tom Porcelli at PGIM. Tom, good to see you.
Good to see you,
Thank you, sir.
Yep.
Let's get back to Mike McKee. Mike, just sum up that conversation. I think this is really important. There's Tom Porcelli basically telling you that to some extent, this Federal Reserve is constrained even if growth decelerates. That if we had an SEP today and they downgraded the outlook for growth, they wouldn't increase their projection implied by the median dot for interest rate cuts, Mike. And I just wonder if that's something you're hearing a lot of as well.
Yes, and we've heard that from a number of Fed officials because, as I mentioned earlier, they would rather be a little bit late on either inflation or growth than to move early in the wrong direction and have to completely reverse. Suppose inflation goes up and you've cut rates because you thought growth was falling. Then you have to go back to where you were, and then you have to go above that again, which only makes things a lot worse for the markets. You can see next week going to be extremely busy, though. We will have this kind of market reaction because we get CPI, PPI, and then retail sales. So we'll get an inflation and growth view next week. And look at CPIs. The forecast is we're going to see a rise, whether it's tariff related or not. And it probably is in terms of the forecasts. We're supposed to see CPI go up again. And that's not going to be particularly good news for people in the markets trying to figure out what the Fed's going to do.
Mike McKee, thank you, sir. Looking forward to Mike's questions in the news conference a little bit later on in Washington, D.C. Jumping in around the table, Vishal Khanduja of Morgan Stanley joins us now for more. Vishal, good morning, sir. It's good to see you.
Great seeing you.
Inflation is the big piece of this story. Do you hear a chairman later on this afternoon that has concluded that the outcome of this policy shift in the last month is weaker growth and stickier inflation?
I think I'll get back to that one as well. In my mind, I think the market is definitely looking for a repeat of that reaction function from the Fed, that they are still focused on more on growth downsides versus inflation upsides here. I think the market is still trying to eke out from the Fed's reaction function. Are they going to look through some of those steamier prints, one of them probably the next week, that is going to come out at a point where growth is not yet showing the deceleration because of the binge that has gone through in the economy? I think the market might be disappointed in that one, given that the Fed is going to be very, very patient. I think they've done the heavy lifting of 100 basis points last year. They can be patient here to see what the data is and then react to it at the back half of the year.
It's how they react and the reaction function that is really important here. So let's build on some of that. They're all saying different things in their speeches. So I'm basing this just on the SEP from last time around. What I see in their reaction function is if inflation does start to creep higher this year, they see it as a one-off and they won't hike. What I also see, though, and this can become more concerning in the months ahead if the data starts to weaken, is that they're basically telling you if growth comes in lower than we expected, we aren't going to rush to cut either. Mm-hmm. How do those two things stack up?
I think they want to be very, very clear about inflation this time. In their minds, around the committee table, they've seen how 2022 worked out. Again, completely different dynamics of supply and demand shock at that point. We're seeing I think the opposite of what is going to happen at this point, given that we are not going to be spending so much from the government. I think we are going to hopefully curtail that, and we have over the last 6 months on that part. We do think that the patients should not be confused with that they don't have enough in the toolkit, and they won't act as fast as they did over the last 2 years when the need was there. I think if you look back in 2022, they were slightly behind the curve. 75 basis points came out. They felt similarly, I think if we had the same meeting, Q3, Q2 of last year, 2 or 3 of those unemployment reports, whether there was noise in the data or they were truly down, came back with 50 basis points, 100 basis points in three meetings very quickly. So I think they feel pretty patient in that, or pretty comfortable in that regard, that they have still quite a bit in the toolkit before the difference between where they are today and where the terminal rate could be if demand destruction shows up in the back half of the year.
That's all predicated on the idea that the United States remains the dominant currency, remains the dominant funding market, that treasuries retain their role as the haven asset and have that sort of counterbalance to any kind of cycle. Do you think that that has changed for the Fed and creates a more challenging backdrop for them to respond in the same way with the same tools?
Absolutely, and I don't think that is just because of April 2nd. That was already happening as we were getting ready for the inauguration day. I think the 4-point agenda from the current administration throughout the election timeframe was tariffs, taxes, immigration, and deregulation. I think the sequencing of that agenda point has been opposite. So yes, the back end is very clearly showing us that it's not about just demand and supply, but about a credible, sustainable deficit reduction plan that we've failed to still show up with at this point.
But you said earlier you think that they're going to curtail government spending. What gives you that conviction? Because every time the Treasury Secretary talks about reconciliation, it's more tax cuts.
Hopefully, I think the two completely opposite forces here, or opposite things that we are hearing from the tariff plan, one is deficit reduction, and then the other side of it, which is completely opposing to that, is manufacturing renaissance here in the U.S. we need to get that clarity. Where is the administration guiding us towards? If it is actually deficit reduction from this, then yes, I think we will see some of those dollars being used for the other side of the tax plan, etc. July 4th is the date there.
So let's get into fixed income. What do you do? Within fixed income, where you're finding diversification, what provides you that ballast in the portfolio if risk starts to gap out, i.e. spread starts to widen? What do you see there? You're dialing up exposure to credit. What are you doing within fixed income right now?
I think we've taken out all our shorts. So we were coming into this, we were at the least amount of credit overweight, almost underweight to investment grade credit at one point in March. So we've taken out some of those. We've started to cover some underweights within credit, within the portfolios, because we are not at 4-decade tights in spreads at that point. Or shorts, in other words, are more expensive at this point because yields and spreads have risen up from that point. But spreads, just to be clear, are not reflective of the demand destruction or the recession that might be in the back of the year or the beginning of 2026. 5-year is a great spot right now.
Why does everyone love the 5-year?
I think it is, you don't have to be specifically correct on when exactly is the Fed going to go. We know demand destruction is coming. We know they have quite a bit in the toolkit. Over the next 18 months, they will be on the dovish side of monetary policy or monetary policy reaction to that one. 0 to 5 year, or probably that 3 to 5 year, gives you that comfort level that you still have a great carry potential for 4% there. Still that negative correlation. I think we've seen that throughout the month of April. I think the back end is what is concerning. So I think we have, yes, I think we don't have too much of steepeners because it's quite a bit of a consensus trade at this point.
Yep.
So we are holding off. 83 basis points on 530s is a great point to re-enter. And it's still low hundreds could be the target there.
Vishal, smart as always. Clinic, thank you, sir. Vishal Khanduja there of Morgan Stanley, echoing what we heard from Priya Misra of JPMorgan a number of hours ago. Like the belly of the curve, a little bit more cautious further out along the curve going to the long bond. Let's give you an update on stories beyond fixed income, some of our top stories this morning. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. Pakistan says it has shot down 5 Indian planes carrying out strikes inside its territory. India says it ordered the strikes against what it calls terrorist camps after last month's attack in Kashmir that killed 26 people. Pakistan says 8 civilians were killed in the Indian raids and has vowed to respond. Weight Watchers has filed for bankruptcy after struggling to compete with popular weight loss drugs like Ozempic. The company plans to execute a restructuring plan that would cut about $1.15 billion in debt from its balance sheet. It needs approval from a bankruptcy judge before it can move forward. And Catholic cardinals from around the world are gathered at the Sistine Chapel for a conclave to choose a new pope. The 133 cardinals will have no contact with the outside world during the process and will not be allowed to leave until they reach an agreement. Like in recent past elections, the process will likely take days. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. We'll catch up with Tyler Kendall down in Washington, D.C. as we wait for Treasury Secretary Scott Bessent to head to Capitol Hill. Live from New York, this is Bloomberg. The opening bell is 38 minutes away and equity futures are firmer by 0.4% on the S&P 500, bouncing back from 2 days of losses on the prospect of talks this weekend between the US and China, which hopefully lead to a reduction in tariffs. Coming up this week, coming up over the next 24 hours, look out for this at 10 a.m. Eastern Time. Day 2 of Treasury Secretary Scott Bessent's testimony on Capitol Hill at 2 p.m. Eastern Time, a Fed rate decision. 30 minutes after that, a news conference with Chairman Powell. On Thursday, another round of jobless claims and a Bank of England rate decision. And this weekend, there it is, US-China trade talks in Switzerland. Joining us now for more, Bloomberg's Tyler Kendall joins us from the nation's capital. Tyler, 10 a.m. Eastern Time, the Treasury Secretary Scott Bessent might get more of a grilling, and this time we've got something to really get our hands around. Talks between the US and China.
Yeah, no doubt, John, that these lawmakers are going to have some fresh questions when it comes to tariffs amid this development that they are jump-starting talks with China this weekend. Now, he's going to be in front of House Financial Services today. It's going to be a full committee hearing. It's going to be much longer than yesterday's. And you had the chance to speak to the chair of that committee, French Hill, yesterday, who told you that the number one question his constituents have is clarity when it comes to the trade strategy amid heightened concerns about price pressures and empty shelves. I'd expect these lawmakers to ask about the timeline in as many different ways as they possibly can. They want to know how quickly can the U.S. get deals done and how quickly can they de-escalate. But in recent days, we've really heard the Treasury Secretary push the broader economic agenda here when it comes to tax cuts and reconciliation, telling people to focus on the bigger picture that these lawmakers are so closely intertwined with. But of course, John, that doesn't mean he's not going to face some tough questions on this too, including by members of his own party. There are at least 3 members of the House Freedom Caucus on the committee today. These are those fiscal hawks that are really pushing this White House for deeper spending cuts to offset their tax cut plan, even amid heightened concerns about what that could mean to benefit programs like Medicaid.
Tyler, thank you for the update. Tyler Kendall down in Washington, D.C. More from Tyler later on the day on Bloomberg TV and on Bloomberg Radio. Lisa, this is what market participants want, the bulls at least. They want the conversation to move from trade and move quickly to taxes.
Yeah, although be careful what you wish for, because if you start to get tax cuts that are not offset by potential gains or savings elsewhere, the bond market starts to perk up a little bit, maybe not in the best way.
What I loved today was Priya Misra talking about peak uncertainty. If that was April 2nd, we've been in a plateau since. The uncertainty is going to continue. Whether or not it's trade, whether or not it's taxes, there's going to be uncertainty for the remainder of this year.
Will we get some clarity later this weekend? You said this repeatedly. The Treasury Secretary has as well, that the situation at the moment between the US and China is unsustainable. The Chinese have said, and we've talked about this all through the morning, the Chinese have basically flagged, they've signalled, we're not going to have serious negotiations about trade until you reduce your tariffs. Is this weekend too soon to expect that to happen?
No, I think that's potentially the one win that could be for both sides out of this weekend, these talks. It's not going to be a deal, but it's going to be de-escalation. So what does de-escalation look like? 145% and 125% come down to something. That has been breadcrumbs from both Beijing and Washington for weeks. So I imagine they can leave Geneva with lower tariff rates.
What is the something? 50, 60, 70? And what is the destination?
And is it sustainable? What every single executive has said is we just want something consistent we can work with. Do you get a sense that what it comes down to is the consistent new normalcy, or is that just a placeholder number as talks continue? And that is a difficult aspect.
What's normal these days? Struggling to work that out, that's for sure.
Amen to that.
Don't know what normal is anymore. We're counting you down to the opening ballots, 35 minutes away. Open interest picks up in just a moment. Equity futures at the moment positive by 0.4%. Coming up at 1:30 Eastern Time, our coverage begins. A Bloomberg Surveillance special. The Fed decides. We'll be catching up with Bob Michael of JPMorgan Asset Management, Kathy Jones of Charles Schwab, Rich Clarida, the former Fed Vice Chair, now at PIMCO, and Jeff Rosenberg of BlackRock. And then tomorrow morning, Stuart Kaiser of Citi, Kelsey Barrow of JPMorgan, Nouriel Roubini of NYU Stern, and the former Kansas City Fed President Esther George. Hope to see you later on this afternoon. Understand if you've got better things to do, but if you want to tune in and talk about the Federal Reserve, we'll be here. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.